Most architects have never been forced to read their own firm's income statement, and the ARE exam writers know it. Your architecture firm is a financial instrument before it is anything else. It takes capital, converts your time into revenue at a measurable multiplier, carries risk through contracts you sign, wins work through business development, and either ends each year cash flow positive or it does not. Module 2 is the diagnostic toolkit for that instrument. The 3 financial statements, the 4 ratios that signal trouble, the fee structures that match scope to risk, the 4 delivery methods and what each one does to your exposure, and the marketing versus business development distinction that quietly decides which projects you take. Get this wrong, and the firm goes under before the design ever ships. 4 reasons finance and risk live in the same module. 4 reasons finance and risk share this module. First, the 3 financial statements are not interchangeable. The balance sheet shows what the firm owns and owes at a moment in time. The income statement shows whether the firm made money over a period. The cash flow statement shows whether the bank account is actually filling up, and the exam will write a question that turns on which statement answers which question. Second, the 4 practice ratios, net multiplier, overhead rate, utilization rate, realization rate, are the firm's vital signs, and each one has a benchmark band a healthy firm operates inside of. Third, fee structure is a risk allocation decision wearing the costume of a billing decision. Lump sum puts scope risk on the architect. Percentage of construction cost puts cost escalation risk on the architect. Hourly leaves the client carrying every risk and erodes the firm's negotiating position. Cost buildup forces a real conversation about staffing. And fourth, delivery method. Design bid build, design build, construction manager at risk, and integrated project delivery changes the architect's contractual position, indemnity exposure, and the standard of care lens the courts will read your file through. Here is the chronological tour of all 7 subsections. Walking the module in order. 2.1 sets up the business reality. Why architects who can pass design get tripped up here, and why PcM score reports tell that story. 2.2 breaks down the 3 financial statements. 2.3 walks the 4 practice ratios: net multiplier, overhead rate, utilization, realization, with the benchmark band for each. 2.4 is the fee structure menu and the cost buildup method that prices any fee defensibly. 2.5 covers the 4 delivery methods: design bid build, construction manager at risk, and integrated project delivery, and the comparison table the exam loves to draw from. 2.6 is project risk and contract provisions, including how the contract documents allocate indemnity and how the construction administration phase carries its own risk profile. And 2.7 is the marketing versus business development distinction, the go, no-go decision that decides which prospects the firm actually pursues, and the proposal and interview discipline that converts pursuit into signed work. One posture set before we open section 2.1. 4 things to hold in mind. First, the right answer protects the firm's cash flow first, and the architect's standard of care exposure second. Every other consideration is downstream of those 2. Second, numbers are the language of this module. The exam expects you to read a multiplier, a ratio, a contract clause without flinching. Don't panic when you see a percentage. Third, delivery method changes everything downstream. When a prompt names design bid build versus design build versus construction manager at risk versus integrated project delivery, read that line first because every other answer choice shifts. And fourth, the discipline to refuse a project is tested too. The go, no-go decision is a real PcM exam topic, not a polite suggestion in the textbook. The firm that takes every project loses money on most of them. With that set, we step into section 2.1. Here is an uncomfortable truth that most architects never want to hear. More architecture firms fail from financial mismanagement than from design failures. A studio can win every award on the wall and still be quietly heading toward bankruptcy. A principal can be a brilliant designer and have no idea whether the projects on the boards are profitable or losing money on every billable hour. NCARB tests this material heavily, between 29 and 35% of the PcM exam, for one simple reason. When a firm runs out of cash mid-project, the client's building sits unfinished, and that is public harm. Exactly the kind of harm the licensing exam exists to prevent. Let me show you the cascade. What happens when an architect cannot read the financial side of the practice? Walk down the 4 failure modes on the left side and notice the public harm consequence on the right. A firm that runs out of cash mid-project leaves a client with an unfinished building, sometimes for years. An underpriced contract forces the principal to cut corners on coordination, on detailing, on construction administration, and the quality of the built work suffers in ways the client cannot see until something fails. A firm with no backlog has to lay people off without warning, and the projects those people were running get abandoned or handed to colleagues who do not have the context. And a firm with collection problems cannot pay its consultants, so the structural drawings get held up, the mechanical engineer stops returning calls, and the whole delivery schedule cascades into delay. Each one of these failures starts as a private business problem and ends as harm to the public the architect is licensed to serve. So what does this module actually teach you to do? 5 concrete financial skills, each tied to a specific business survival risk. 5 skills, each tied to a real consequence. Reading financial statements is how you tell whether your firm is healthy or quietly dying. And the early warning signs are always in the numbers before they show up in the hallway conversations. Calculating fees correctly is how projects actually make money instead of just keeping the office busy. An underpriced job is not a learning opportunity. It is a slow bleed. Understanding delivery methods is how you advise clients without exposing your firm to risk you did not negotiate for and did not price into the fee. Assessing risk is how you recognize the contract clauses that have bankrupted other firms before you sign your name to one of them. And business development is how you keep the pipeline full, because the firms that get sued for malpractice are very often the same firms that took a desperate project from a client they should have walked away from. Whatever your role today, the financial knowledge required of you is going to change as your career advances. Notice how the expectation escalates with each step in the career ladder. The intern needs the basics. Track your hours honestly. Understand how those hours become a client invoice. And recognize that timesheet entries are not paperwork, they are revenue. The project architect needs to monitor the budget the project manager set. Watch for overruns and flag them early, because an overrun caught in week 6 is a conversation, and an overrun caught in week 16 is a write-off. The project manager owns the fee. They forecast labor across the remaining phases, negotiate change orders with the client when the scope shifts, and make the small decisions every week that determine whether the project hits its profit target. And the principal owns the whole picture: the firm's profit and loss, the firm's balance sheet, and the personal liability that comes with being the licensee whose seal is on every drawing. The most common path to becoming a principal is not best designer gets promoted. It is the person who can manage projects profitably and design well who gets trusted with the business. Step back from the 4 roles and the 4 skill sets, and the takeaway is the same. Design talent without financial literacy is a career ceiling. 5 takeaways from this opening section. First, more architecture firms fail from financial mismanagement than from design failures, which is why this module covers 29 to 35% of the PcM exam. Second, financial failure cascades into public harm. Unfinished buildings, abandoned projects, consultants unpaid, delays compounding on delays. And that public harm chain is exactly why the licensing body cares whether you can read a balance sheet. Third, The module builds 5 concrete skills: reading statements, calculating fees, understanding delivery methods, assessing risk, and developing business. Fourth, the financial knowledge required of you scales sharply as you move from intern to project architect to project manager to principal, and pretending you can avoid that growth is how careers stall. And fifth, the architects who become principals are not the best designers in the studio. They are the people who can manage projects profitably and design well, and the firm trusts them with the business because they have already proven they can be trusted with the numbers. Every business in the world keeps 3 core financial statements, and each one answers a different question. Most architects encounter them in school as a single confused blur and walk into firm leadership unable to tell them apart. That is the gap this section closes. The balance sheet, the income statement, and the cash flow statement are not 3 versions of the same report. They are 3 different cameras pointed at the firm, and you need all 3 to see what is actually going on. A firm can look profitable on paper, run out of cash, and be unable to make payroll on a Friday. The principals who do not understand the difference end up in bankruptcy, sued by consultants and lenders, convinced they were doing fine, right up to the day the bank account hit 0. Start with the 3 questions each statement is built to answer. 3 statements, 3 questions. The balance sheet answers what the firm owns and what the firm owes at a specific moment, typically the last day of the month, the quarter, or the year. It is a snapshot. The income statement, sometimes called the P&L for profit and loss, answers whether the firm made money over a period of time, like the month of March, or the second quarter, or the fiscal year. It is a movie of the firm's revenue and expenses, frame by frame. The cash flow statement answers a different question entirely. Where did actual cash come from, and where did it go during that same period? Cash flow is also a movie, but it is tracking the bank account, not the books. Confusing the snapshot with the movie, or confusing the income statement with the cash flow statement, is one of the most expensive errors a young principal can make. If the 3 statements still feel abstract, here is the analogy that makes them click: your own personal finances. Map this onto your own life, and it stops being abstract. Your personal net worth statement is what you own minus what you owe at a point in time. Your savings, your retirement account, and your house minus your mortgage, your credit card balance, and your student loans. That is a balance sheet. The question of whether you saved money this month or spent more than you earned is your personal income statement. Revenue minus expenses, profit or loss for the period. And your bank account activity, the actual deposits and withdrawals you can see on your statement, is your personal cash flow. The architecture firm runs on the same 3 views, just with more line items and a larger scale. Once you accept that the 3 statements are answering 3 different questions, the confusion lifts. Each statement is powerful, but each one also has a critical blind spot. And that is what makes all 3 necessary. Now consider what each statement hides. The balance sheet shows you a healthy stack of assets, but it does not tell you whether you are profitable, because those assets might all have been funded by loans you still have to repay. The income statement shows you a beautiful profit number for the period, but it does not tell you whether you have cash, because that profit could be sitting in unpaid receivables from clients who will not pay you for another 60 or 90 days. The cash flow statement shows you plenty of cash moving through the bank, but it does not tell you whether you are profitable long-term, because that cash could be coming from selling off equipment, drawing down a line of credit, or burning the reserves you spent a decade building. This is exactly why a firm can be profitable on paper and run out of cash waiting for receivables. And it is also why a firm can have cash on hand and be quietly unprofitable, spending down reserves while losing money on every project. You need all 3. Step back, and the takeaway is simple. Financial health is a triangulation problem, not a single number on a single page. 5 takeaways from this section. First, every business keeps 3 core financial statements, and each one answers a question the other two cannot answer. Second, the balance sheet is a snapshot at a moment in time, while the income statement and the cash flow statement are movies over a period. That time frame distinction is what most beginners get wrong. Third, the analogy that makes the structure click is your own personal finances. Net worth, monthly savings, and bank account activity map cleanly onto the three statements. Fourth, each statement has a blind spot. The balance sheet hides profitability, the income statement hides cash, and the cash flow statement hides long-term viability. And that is why no single statement is sufficient. And fifth, the most expensive lesson a young principal can learn is that profitable on paper and cash in the bank are not the same condition, because the firm that confuses the two cannot make payroll on Friday. Every balance sheet you will ever read obeys the same equation. Assets equals liabilities plus owner's equity. It is the most fundamental rule in accounting, and it always balances. That is not magic, it is bookkeeping by definition. Every dollar of asset on the firm's books was funded by something, and that something is either money the firm owes to someone else, which is a liability, or money the owners put in or left in, which is equity. The reason this matters for you as a future principal is uncomfortable. A young architect can be sued personally when the firm's balance sheet falls apart, because if the equity is gone and the liabilities exceed the assets, the firm is technically insolvent, and the people who signed personal guarantees on those liabilities are the ones on the hook. Walk through the three components: assets, liabilities, and equity, and what each one actually contains for an architecture firm. Three components, each with its own subcategories. Assets split into current, fixed, and other. Current assets are anything you can convert to cash within a year. And in an architecture firm, that means cash itself, accounts receivable from clients who have been invoiced but have not paid yet, and work in progress, which is fees you have earned by doing the work but have not invoiced yet. Fixed assets are the long-term things you bought to run the firm: computers, furniture, leasehold improvements on the office space. Other assets are everything else, like security deposits with the landlord and prepaid insurance. Liabilities split into current and long-term. Current liabilities are what you owe in the next 12 months. Accounts payable to consultants and vendors, accrued payroll for the next pay cycle, the current year's portion of any bank loan. Long-term liabilities are bank loans and equipment financing that extend beyond a year. Owner's equity has two pieces: capital contributions, the money the owners actually put in, and retained earnings, which are accumulated profits the firm has chosen to keep rather than distribute. Now here is the part that makes an architecture firm balance sheet look strange to anyone who came from manufacturing or retail. An architecture firm balance sheet looks unlike most businesses, and the difference is critical to understand. Between 70 and 80% of total assets are accounts receivable plus work in progress, money clients owe you, and money you have earned but not yet invoiced, while fixed assets are minimal because we do not need factories, inventory, or anything beyond computers that depreciate to nothing. The implication is sobering. Your firm's largest asset is essentially a promise that clients will eventually pay the invoices you have already sent, and promises are not cash. Receivables that age past 90 days are at real risk of becoming write-offs, especially when a client disputes the work, runs into their own financial trouble, or simply decides to stop returning your calls. A balance sheet stacked with old receivables looks healthy on paper, but is fragile. Cash that never actually arrives is the most common cause of architecture firm bankruptcies. Not bad design, not malpractice, but receivables that quietly went bad while the principal was busy designing the next project. Put it all together in a sample balance sheet for a small firm, and the structure becomes concrete. Read the sample balance sheet across both sides. On the left, assets total $520,000, but the composition matters more than the total. Only $50,000 is actually cash, while $320,000 is accounts receivable from clients who owe but have not yet sent payment. And another $80,000 is work in progress, meaning fees earned but not yet billed. Combined, that receivable and work in progress pile is roughly 77% of total assets, which is expectation, not money in hand. Equipment is $40,000 and leasehold improvements are $30,000, rounding out the asset side. On the right, liabilities and equity also total $520,000 because the equation always balances. $80,000 is owed to consultants and vendors in the next month or two as accounts payable. $40,000 is accrued for payroll and other obligations that have built up but not yet been paid, and the bank loan is split. $30,000 in the current portion due within a year and $70,000 in the long-term portion. The remaining $300,000 is owner's equity, the cumulative money the owners put in, plus profits they have retained. The firm looks healthy on paper, but its survival depends entirely on collecting that $320,000 in receivables and $80,000 in work in progress. One more thing before we move on. The balance sheet is powerful, but on its own, it is incomplete. 5 takeaways. First, the balance sheet obeys one equation. Assets equals liabilities plus owner's equity, and it always balances by definition. Second, assets split into current, fixed, and other. Liabilities split into current and long-term. Owner's equity is capital contributions plus retained earnings. Third, for an architecture firm, 70 to 80% of total assets are accounts receivable plus work in progress, which means most of what looks like wealth is actually expectation. Fourth, receivables that age past 90 days are at real risk of becoming write-offs, and that is why a balance sheet stacked with old receivables is fragile, even when the totals look healthy. And fifth, the balance sheet shows you what the firm has, not what the firm earned. A firm could hold $500,000 in assets and have earned none of it, because every dollar came from borrowed money. That is the gap the income statement is built to close, and that is where we go next. The income statement, sometimes called the P&L for profit and loss, answers one question. Did the firm make money over a defined period of time? That period might be a month, a quarter, a fiscal year, or the trailing 12 months, but it is always a span, never a snapshot. Every architect who has ever sat in a partners meeting and watched a year-end review has watched an income statement get read line by line. And every architect who has ever been blindsided by their firm losing money has been blindsided because no one taught them to read this document. By the end of this section, you will be able to walk the income statement top to bottom, identify the 3 levels of profit, and know exactly which one is the most overlooked early warning signal. Walk the structure of the income statement from the top line down to the bottom line, 6 steps in order. 6 steps from the top line to the bottom line. Step 1 is net revenue, the fees you earned minus the consultant pass-throughs you billed to clients on behalf of others. Pass-throughs are not money you keep. Step 2 subtracts direct expenses, direct labor for billable project hours, consultants whose work was project-specific, printing, and project travel, the costs tied directly to producing the work. Step 3 gives you gross profit, the answer to the question of whether the projects themselves are profitable before you layer overhead on top, and if gross profit is unhealthy, no amount of overhead control will save the firm. Step 4 subtracts indirect expenses, administrative salaries, rent, utilities, insurance, software, and marketing, the costs of having a firm at all. Step 5 gives you net operating income, which tells you whether the core business is profitable once overhead is fully accounted for. Step 6 subtracts other items, interest on debt and taxes and one-time charges to arrive at net profit. That is the bottom line, the number that determines whether the firm survives or quietly slides toward bankruptcy. Each line item carries meaning beyond the dollar figure. Walk through the ones that matter most for architecture firms. 6 line items worth pausing on. Net revenue is what you actually keep. Fees earned minus consultant pass-throughs that flow straight through to others. Direct labor is the cost of billable project hours, and it is the raw material of an architecture firm, the same way steel is the raw material of a fabrication shop. Direct expenses bundle the consultants and printing and project travel that get charged to specific projects. Indirect labor is the admin, marketing, and management salaries that keep the firm running but cannot be billed to any one project. Other overhead is rent, utilities, insurance, and software. And net profit is what remains after every single expense, the goal of running the business, and the number that determines whether the firm can pay its principals at year-end, fund growth, weather a slow quarter, or hand its owners back what they put in. 3 levels of profit are visible inside this statement: gross, operating, and net. And most architects look only at the last one. That is a mistake. Concrete example. Read a sample income statement for a firm doing $2 million in net revenue. Read the sample down the page. Net revenue is $2 million. Call that the top line, 100%. Direct labor of $800,000 plus direct expenses of $200,000 equals $1 million in direct costs, which is 50% of revenue. Subtract those, and you get gross profit of $1 million, also 50%. Indirect labor of $400,000 plus other overhead of $400,000 equals $800,000 in overhead, which is 40% of revenue. Subtract overhead from gross profit, and you get net operating income of $200,000, or 10%. After roughly $20,000 of interest and other items, net profit is $180,000, or 9% of revenue. The benchmark for a healthy firm is net profit in the high single digits to low double digits. 9% on $2 million is firmly in the healthy range. But the most important number on this whole statement is the direct labor line. Direct labor at 35 to 45% of net revenue is the band of health. Higher than 45%, and either your billing rates are too low or your utilization is poor. Too many hours sitting unsold. Lower than 35%, and you may be understaffed, over-relying on outside consultants, or simply not invoicing all the work you actually performed. Pull it all together, and a clear set of rules emerges for reading any income statement that lands in front of you. 5 takeaways. First, the income statement, or P&L, measures profitability over a period of time, month, quarter, or year, and never at a single instant. Second, 3 profit levels live inside this statement. Gross profit answers whether projects are profitable before overhead. Net operating income answers whether the core business is profitable with overhead included. And net profit is the final bottom line after interest and taxes. Each level diagnoses a different layer of the firm. Third, direct labor as a share of net revenue is the canary in the coal mine. Healthy firms run 35 to 45%, and drift in either direction signals a problem in pricing, utilization, or staffing. Fourth, net profit in the high single digits to low double digits as a share of revenue is the benchmark for firm health. Anything below that, and the principals are working for free relative to what they could earn elsewhere. And fifth, profit on paper still does not equal cash in the bank, which is exactly why the cash flow statement is the third leg of the stool, and exactly where we go next. Here's the most uncomfortable truth in firm finance. A firm can be profitable on paper and still go bankrupt at the bank. Architects who spent their careers thinking profit and cash are roughly the same thing learn the difference the week they cannot make payroll on a project they have already completed and not yet collected on. This is the single most important concept in practice financial management, and it is the one most likely to surprise a principal who has never run a firm before. Profit is an accounting story about whether revenue exceeds expenses over a period. Cash is whether there are dollars in the operating account today to pay the people who showed up to work this morning. Those two things diverge constantly, and the size of that gap is what determines whether your profitable firm survives its own growth. Start with the definition itself, because the word profit hides what's actually happening. Under accrual accounting, which every firm above a sole proprietor uses, revenue is recorded when the work is performed, not when the client pays. So the income statement shows the firm earned $100,000 the week the project work was done, even though no money has changed hands. The same accrual logic governs expenses. Payroll is recorded when employees earn it, not when checks clear. The result is two separate timelines running side by side. The income statement timeline shows a profitable firm. The cash timeline shows an operating account that drains every 2 weeks for payroll while waiting for clients to send checks. When those two timelines drift far apart, the firm runs out of money to pay people who are working on profitable projects. That is how a firm goes bankrupt while showing a profit. The clearest way to see the gap is to follow a single $100,000 project through the books. Walk through $100,000 of project work and watch the two timelines diverge. The week the team completes the work, the income statement records $100,000 of revenue, and the firm looks more profitable. Cash impact at that moment is zero, because nothing has been billed. A few days later, the invoice goes out. Again, no change to the income statement because the revenue was already booked, and still no cash. The client pays 60 days after that, which is when the bank account finally sees the $100,000. In those 60 days, payroll has hit the account 3 times, rent has gone out twice, and an insurance premium may have come due. The income statement still says the project was profitable. The bank balance says you needed a line of credit to survive between performing the work and collecting on it. And here's the part that surprises principals. Rapid growth makes this gap worse, not better. Most principals assume that winning a big new project is unambiguous good news. It isn't, at least not financially. Walk through what actually happens step by step. The firm wins the project and signs the contract. To deliver, you have to staff up immediately, which means new payroll obligations hitting the bank account in the next 2-week cycle. The team then works for 60 to 90 days before the first invoice goes out because billing milestones are usually tied to deliverables rather than to time. The client then takes another 30 to 60 days to pay that first invoice. Add those two windows together, and you've funded 2 to 3 months of expanded payroll before any cash from the new project arrives. Firms that grow fast without a line of credit or a cash reserve to absorb that gap will run out of money in the middle of a wildly profitable year. The bigger the win, the bigger the cash hole on the way to collecting on it. Which brings up the single most important number you should be watching every single week. There is one number that every firm principal should be tracking weekly: the aging of accounts receivable. Invoices that age past 90 days frequently become write-offs, either because the client has cash problems of their own or because a dispute has surfaced that nobody told you about. By the time a quarterly close flags an unpaid invoice as a problem, the cash you thought you had on that project is often gone for good. The discipline is to watch the aging report every single week, call the client the day an invoice ages past 45 days, and escalate to the principal level before it crosses 90. A project is only profitable if you actually collect the money. Revenue you cannot collect is not revenue. It is a write-off masquerading as a number on your income statement, and it will distort every decision you make until you take it off the books. Quick recap, then on to the financial ratios that turn this discipline into a system. 5 takeaways from cash flow versus profit. Profit and cash are not the same thing. Profit is an accounting measure of revenue against expense over a period, and cash is what's actually in the operating account today. Under accrual accounting, revenue is recorded when work is performed. but cash from that work typically arrives 60 to 90 days later, while payroll, rent, and insurance keep going out on their own schedules. Rapid growth makes the gap worse, not better, because new staff have to be paid for 2 to 3 months before the project they were hired for delivers its first collection. The single most important operational discipline is watching accounts receivable aging weekly, because receivables past 90 days frequently become write-offs. And the bridge between profitable work and surviving the wait for cash is either a working line of credit or a deliberate cash reserve. Without one of those, a profitable firm can still fail. If you walk away from this module remembering exactly one number, make it the net multiplier. It is the single metric that decides whether the firm is operating as a business or running as an expensive charity for its clients. The question it answers is simple. For every dollar the firm spends on direct labor, that is, on people billing time to projects, how much revenue does the firm actually generate? When the answer is below the industry benchmark, the firm is structurally unprofitable no matter how busy the team feels or how good the work looks. Architects who run their firms by gut feel almost always discover, too late, that their multiplier was below water for years, and the firm was funded by the principal's personal credit and unpaid overtime. The math is so basic it's almost insulting, and that's exactly why missing it is so costly. Start with the formula itself, because the components matter as much as the ratio. Net multiplier equals net revenue divided by direct labor. Net revenue is the fee the firm actually keeps. Gross revenue minus consultant pass-throughs and reimbursable expenses you billed but didn't earn. Don't put gross revenue in the top of this ratio. If you do, you'll fool yourself into thinking you're profitable when you're really just running money through the books for engineers. Direct labor on the bottom is the cost of staff time charged to projects, the salaries, payroll taxes, and benefits for hours that show up on a timesheet against a project number. Indirect labor, like the principal selling work or admin staff running the office, does not belong in direct labor. It lives in overhead. A multiplier of 3 means every dollar of direct staff time produces $3 of fee the firm retains, and that 3 has to cover the labor itself, the overhead burden, and finally, a margin of profit. What separates a healthy 3 from an unsustainable 2 is the AHPP benchmark band. AHPP publishes industry benchmark bands, and your firm's number lands in one of 5 places. Below 2.5, the firm is structurally struggling. Either overhead has gotten away from leadership, or fees are being underquoted in the proposal stage. Between 2.5 and 2.7, the firm is below the AHPP benchmark and is not yet sustainable on its own. The principal is usually subsidizing the difference with unpaid time or personal capital. Between 2.7 and 3.0 is the healthy floor, the AHPP industry benchmark, where overhead is under control and pricing matches the work. Between 3.0 and 3.5 is a strong firm. Good overhead discipline, fees that match value delivered, and real profit at year-end. Above 3.5 is excellent and is usually a sign of premium positioning or a very lean operation. Boutique firms with strong reputations or production firms with disciplined process and low overhead. Why is 2.7 the floor? Because of what the multiplier actually has to pay for. 2.7 is not an arbitrary benchmark. It falls out of the math. Take a firm with an overhead rate of 150%, which is roughly the industry average. Every dollar of direct labor has to cover $1 of labor cost plus $1.50 of overhead. That's $2.50 just to break even before profit. Add even a modest profit margin on top, say 10 to 15%, and the firm needs to bill closer to 2.7 for every dollar of direct labor just to clear zero with a small return. That's why 2.7 shows up as the floor of the healthy band. Anything below it means one of 3 things is happening. The firm is losing money on every project. The principals are absorbing the gap by not paying themselves a market salary, or somebody is borrowing against future receivables to fund the present. Architects who don't run this math run all three at once and call it normal. There's a cautionary tale in the AHPP that makes the math personal. AHPP tells the story of Hartley Design Associates, 18 talented architects producing beautiful work, always busy, always exhausted, and always broke. The math explains why. Their direct labor was $850,000, and their net revenue was $1.7 million, putting their multiplier at exactly 2.0. With an overhead rate of 160%, slightly above average, they needed a multiplier of 2.6 just to break even before any profit. They were short 0.6 of a multiplier on every single project. That gap, multiplied across the entire year, was the hundreds of thousands of dollars the principals were absorbing through unpaid time, deferred distributions, and credit card balances. The painful but only solution was to raise billing rates by 30%, except that 3 clients would walk because the new rates exceeded their willingness to pay, and run a smaller firm on the work that remained, work that was now profitable. The firm survived. The principals stopped subsidizing their clients. Quick recap of the formula and the floor. 5 takeaways on the net multiplier. The formula is net revenue divided by direct labor, and it is the single most important number a firm principal can track. Net revenue is fees the firm actually keeps. Exclude consultant pass-throughs and reimbursables from the top of the ratio, or you'll fool yourself. Direct labor is the cost of staff time charged to projects on timesheets. Admin and selling time live in overhead, not here. The AHPP healthy floor is between 2.7 and 3.0. Anything below 2.7 means the firm is structurally underwater, and the principals are usually absorbing the gap personally. The math behind that floor is straightforward. At 150% overhead, the multiplier has to clear 2.5 just to break even, and a real profit target pushes it to 2.7. The alternative form of the same formula, 1 plus overhead rate multiplied by 1 plus profit margin, is the cleanest way to set a target multiplier from a target profit margin. And it's the version that shows up on the exam. Of the 3 or 4 levers a firm principal can pull to fix profitability, overhead is the only one that is fully under your control. You don't control how fast a client pays. You don't really control what the market will bear for architectural services in your region. And you don't control whether a recession lands next quarter. You do control how many admin staff you carry, what kind of office you occupy, how much software you subscribe to, and how often the firm picks up the tab for entertaining clients who never sign. Which is why overhead rate is the single most important controllable metric. And it is also the one that quietly drifts upward year after year while nobody is paying attention. Each individual increase feels reasonable in the moment. Hiring 1 more admin, moving to a slightly nicer office, adding 1 more software subscription. Years later, the rate is at 180%, and the profit is gone. And nobody can point to the decision that caused it because there was no single decision. Start with the formula, because the framing decides what counts and what doesn't. Overhead rate equals total indirect costs divided by direct labor, expressed as a percentage. Direct labor is the same denominator you used for the net multiplier, the cost of staff time charged to projects on a timesheet. Indirect costs is everything else the firm spends to stay in business. Rent, utilities, admin salaries, principal time spent selling rather than producing, insurance premiums, software subscriptions, professional development, marketing expenses, entertaining, the legal and accounting bills, the office plants. If a dollar leaves the firm and it isn't paying someone for time charged to a project, it's overhead. Translating that ratio into a number tells you, for every dollar of direct labor you spend, how many cents of overhead burden the firm has piled on top. A rate of 150% means that for every dollar of project labor cost, the firm is also carrying $1.50 of indirect cost. The trap is in what people don't count as overhead, and what most firms miss until the audit. 5 buckets cover most firm overhead, and most firms underestimate at least one of them. Indirect labor is the largest and the most often misclassified. Admin staff, marketing personnel, and any principal time that isn't on a project timesheet all belong here. Principals especially fool themselves by working 60-hour weeks and only charging 40 hours to projects. The other 20 hours are overhead, even though no check is being written for them. Occupancy is rent, utilities, parking, and building maintenance. Administrative is insurance, legal, accounting, and the entire stack of software subscriptions that has quietly grown to 30 or 40 individual line items. Marketing and business development is proposals, conferences, entertaining, the firm website, and any unpaid pursuit time. Professional development is training, licensure renewals, and AIA memberships. Run an honest audit of those 5 buckets at the end of every fiscal year, because the overhead rate you've been quoting yourself is probably lower than the real one. The benchmark bands tell you where your honest numbers should land. AHPP publishes overhead bands the same way it publishes multiplier bands. Below 130% is very lean, and often means the firm is underinvesting in infrastructure. Not enough admin support, no real marketing function, deferred software upgrades that the team is working around. Between 130 and 150% is efficient and well managed. Between 150 and 170 is the typical range for established firms. Staffed properly, decent office, normal software stack. Between 170 and 200% indicates overhead bloat. The firm has accumulated indirect costs faster than it grew direct labor, and the profit margin is being squeezed from the cost side. Above 200% is structurally problematic. Overhead is now consuming the profit the firm should be making, and no amount of pricing discipline on the project side will fix it until the cost side is cut. Which is why the practical target most firms aim at is exactly one number. 150% is the practical target most well-run firms aim at. It's the rate that lets a healthy net multiplier, somewhere between 2.7 and 3.0, actually translate into a real profit margin at year-end. The reason it's the target rather than something lower is that genuinely lean firms tend to underinvest in the infrastructure that supports growth. Marketing gets cut, training gets deferred, software gets stretched past its useful life, and the firm gradually loses the ability to compete for better work. Target 150, audit it annually, and resist the creep. The creep is what kills firms. Each individual decision to add headcount or move to a nicer office or subscribe to a new platform is defensible on its own merits. The cumulative drift is what shows up on the year-end income statement as a profit margin that has quietly shrunk by 3 points without any single dramatic event to explain it. Quick recap, then onto utilization, the metric that decides whether the people you're carrying are actually billing. 5 takeaways on overhead rate. The formula is indirect costs divided by direct labor, expressed as a percentage. For every dollar of project labor, how much indirect burden is the firm carrying? The 5 categories that make up indirect cost are indirect labor, occupancy, administrative, marketing and business development, and professional development. The AHPP Healthy Band runs from 130 to 170%, and the practical target most well-run firms aim at is 150. Principal time that isn't on a project timesheet is overhead. Count it honestly, because pretending it doesn't exist is what makes the rate look lower than it really is. And the structural risk is creep, not any single dramatic decision. Audit overhead every fiscal year and push back on the slow accumulation of indirect cost that quietly erodes the margin the firm thought it was earning. Every architect who runs a firm thinks they know the answer to one question. Are the people I'm paying actually working on billable projects? Most of them are wrong. Utilization is the third ratio in the AHPP trio, and it measures the gap between hours worked and hours billed. You assume the answer is yes because the team looks busy, the office is full, and timesheets get submitted on time. But hours spent on training, business development, internal coordination, vacation, and admin all show up on the payroll register, and none of them show up on a client invoice. A firm that doesn't track utilization is flying blind on the largest single line item on its income statement, which is staff cost. Getting this number wrong by even 5 percentage points across a year is the difference between a profitable year and a loss that nobody saw coming. Start with the formula and the math at the individual level. Utilization rate equals billable hours divided by available hours. Available hours per full-time employee is conventionally 2,080 per year, which is 40 hours times 52 weeks. Billable hours is time charged to a project number, regardless of whether the client has been invoiced yet. So a staff member who logs 1,456 billable hours in a year is at 70% utilization. 70% of their available time generated revenue, and the other 30% did not. The denominator is fixed at 2,080, whether the person actually worked that or worked 60-hour weeks. That convention matters. If you let people overstate available hours by counting overtime, you'll inflate the denominator and the rate will look healthier than it is. Stay disciplined on 2,080 as the available hours figure across the board and the comparisons stay honest. What a healthy individual rate looks like depends on the role, but the firm-wide number has a single benchmark. Read the firm-wide number on the left and the individual targets on the right as two separate diagnostics. Start with the firm-wide average, because that's the number that decides whether the cost structure works. Between 60 and 65% firm-wide is the AHPP and Deltek Clarity benchmark. That floor sounds low to architects who haven't thought about it, but it accounts for the fact that admin staff are 0% billable by definition. Principals run well below their production teams, and everyone takes vacation. Below 55% firm-wide is a serious problem. Either overhead has bloated through too many non-billable roles, or there isn't enough project work for the team you've staffed. Individual numbers tell a different story. An individual above 80% looks great on paper and is often a warning sign that the person is overworked and approaching burnout. Between 65 and 75% for an individual contributor is healthy. They have time for admin, training, and the occasional business development task. Below 60% at the individual level usually means there isn't enough project work to fill the role, which is a planning failure, not an employee failure. The reason the firm-wide number sits lower than the individual ranges is that different roles have very different targets. Different roles have different appropriate utilization targets, and lumping them together is what produces misleading firm averages. Production staff, whose job is to draw, model, and document, should run between 75 and 85%. Their entire role is project work, and if they're below that range, the principal hasn't sold enough work to keep them loaded. Project managers should run between 65 and 75%. The other 25 to 35% of their time goes to managing the team, coordinating with consultants, handling client communication, and tracking schedule and budget. Principals run lower still, between 40 and 60% on average, because their job is partly to deliver and partly to sell the work that will keep everyone else employed 18 months from now. A principal at 90% utilization is a principal who hasn't sold any new work this quarter, and the firm will feel that absence next year. Admin staff are 0% by definition. Their entire role lives in overhead. Build the firm-wide average from the mix of roles you actually have, and the 65% floor makes sense. Which brings up the single biggest misconception about utilization. Higher is not always better. 60 to 65% firm-wide is the AHPP and Deltek Clarity benchmark, and the temptation for first-time principals is to push past it, on the theory that higher must be better. It isn't. The 35 to 40% of time that isn't billable is doing necessary work: business development that fills next quarter's pipeline, training that keeps technical skills current, internal coordination that keeps projects from going off the rails, and rest that keeps people from burning out and leaving. A firm operating at 90% firm-wide utilization is a firm that has stopped investing in itself. No pipeline because nobody is selling, no skill development because nobody is training, and high turnover because nobody is resting. 12 to 18 months later, that firm is in trouble in ways that look unrelated to utilization, but that all trace back to the same root cause. Utilization is a balance, not a maximization problem. Treat it as a balance, and the firm survives the bad years. Quick recap of the 3 financial ratios you should now be running every month. 5 takeaways on utilization rate. The formula is billable hours divided by available hours, with available hours fixed at 2,080 per full-time employee per year by convention. The firm-wide target is between 60 and 65%, the AHPP and Deltec Clarity benchmark, and that floor accounts for admin staff at 0, principals below their teams, and normal vacation and training. Role-based targets vary widely. Production staff between 75 and 85%, project managers between 65 and 75, principals between 40 and 60, and admin staff at 0 by definition. 100% is a warning sign, not a goal. It means no business development, no training, no rest, and a firm that will struggle in the next 12 to 18 months. And anything below 55% firm-wide indicates either overhead bloat from too many non-billable roles or a real shortage of project work for the team you've already staffed. Every architecture firm has 2 top-line numbers, and most owners only watch one of them. The first is what you bill: invoices sent, fees stipulated, the headline revenue on the proposal. The second is what you actually collect, after write-offs, after disputes, after the scope creep you couldn't bill back. The gap between those 2 numbers is where firms quietly bleed profit, and the metric that exposes it is the realization rate. A firm running at 92% realization on $2 million in billings has already lost $160,000 before it pays a single overhead bill. That money never shows up in the bank account, never funds a bonus pool, and never reaches the owner's distribution. It evaporates because the contract was loose, the change order never got written, or the client pushed back on a line item that should have been defended. Let me start with the formula and what each side of it actually represents. The formula is straightforward. Realization rate equals the amount collected divided by the amount billed, expressed as a percentage. A firm that invoiced $100,000 and ultimately deposited $92,000 is running at 92%. That $8,000 shortfall is not a rounding error. It's revenue the firm earned, billed for, and then lost, somewhere between the invoice and the bank statement. The benchmark target for a well-run firm is 95% or higher. Consistent performance below 90% is a signal that something structural is broken, whether in the contract, the scope change process, or the collection discipline. The metric matters because every percentage point of realization improvement flows almost entirely to the bottom line. There is no marginal cost to collecting money you already earned. So the next question is mechanical. What are the specific failures that drive realization below 100%? 5 specific failures account for almost all realization leakage, and each one is a contract or process problem rather than a market problem. Write-offs happen when a client disputes a line item and the firm reduces the invoice to preserve the relationship. The dispute is usually a sign that the scope wasn't clearly defined up front. Scope creep is the largest contributor in most firms. Work that was actually performed but never converted to a written change order, which means the time shows up in the cost column but never makes it to the revenue column. Bad debt covers the client who simply refuses to pay or who goes insolvent before the invoice clears. Discounts are negotiated reductions granted after the fact, usually to close out a project under pressure. And billing errors are the smallest category, but the most embarrassing. An invoice issued incorrectly, credited and reissued, with some portion of the original never recovered. Once you've identified the leakage sources, the benchmark grid tells you whether your performance is healthy or whether it's a 4-alarm fire. The benchmark grid maps your realization number to a diagnostic. 95 to 100% is the excellent band. Strong contracts, disciplined change order practice, clients who pay invoices on time. 90 to 95 is good. Some leakage is happening, but it's within the tolerance that any professional services firm should expect. Below 95, but above 90, means somebody is doing the basics right, but a few specific items are slipping. The concerning band is 85 to 90%, and at that point, the firm has either a scope creep problem the principals haven't acknowledged or a collection process that isn't being enforced. Either way, it requires direct intervention from leadership rather than a memo to the bookkeeper. Below 85% is a structural problem. The firm is funding work it cannot recover, which means it's effectively running at negative margin on whatever portion of the work is being given away. The reason this metric deserves senior leadership attention is that small changes produce large dollar swings. Here's the number that should make every owner pay attention. A 5-point lift in realization on $2 million of annual billings is exactly $100,000 in found profit. That's not new revenue. It's recovery of revenue the firm already earned but didn't collect. The firm didn't win a single new project to produce it. It didn't add staff, didn't expand into a new market, and didn't raise its rates. It simply collected on work it had already done. For most firms, the path from 85 to 90% realization is shorter and cheaper than the path to one extra project of that size, because the work is already in the cost column. Closing the leakage flips it into the revenue column without adding overhead. Recap. Then we move into the broader picture of firm liquidity and short-term financial health. 5 takeaways on realization rate. The formula is simple. Amount collected divided by amount billed. And the target band for a well-run firm is 95% or higher, with anything below 90 signaling a structural rather than a cosmetic problem. The 5 drivers of leakage are write-offs, scope creep, bad debt, discounts, and billing errors, and they are almost always contract or process failures rather than market conditions. Scope creep without written change orders is the single largest contributor in most architecture firms because the work gets done and the cost shows up, but the revenue line never moves. And the math on improvement is striking. A 5-point lift in realization on $2 million of billings is $100,000 of pure margin recovery, one without a single new project. Most architects who run their own firm watch the wrong financial alarm. The visible failure mode you worry about is unprofitability. The firm loses money quarter after quarter, and the equity erodes until there's nothing left. The invisible failure mode is illiquidity, and it kills profitable firms regularly. Your firm can be technically profitable on the income statement and still miss payroll, because profit is an accounting concept, and cash in the operating account is what actually pays salaries on the 15th and the 30th. The 3 ratios in this section, the current ratio, accounts receivable days, and debt to equity, are the survival metrics. Banks watch them, bonding companies watch them, buyers watch them when a firm goes up for sale, and the firms that watch them themselves are the ones that see trouble coming with enough runway to do something about it. The first of the 3 is the current ratio, which measures whether your liquid assets cover the bills coming due. The current ratio is the most watched single liquidity metric in professional services finance. It's the ratio of current assets, meaning cash on hand, accounts receivable, and anything else that converts to cash within 12 months, divided by current liabilities, meaning all obligations due within those same 12 months. A current ratio of 1.5 means the firm has $1.50 of near cash for every dollar of near-term obligation. A ratio of 1 means it has exactly enough. Below 1 is the danger zone, because the liquid assets do not cover the obligations and something has to give, either an asset sale, a new line of credit, or a missed payment. The healthy band for architecture firms is 1.5 to 2.0. Higher than that often signals that cash is sitting idle when it should be reinvested or distributed. The benchmark grid maps your ratio to a specific diagnostic and an appropriate response. Below 1.0 is the danger band. The firm's near-term liabilities exceed its near-term liquid assets, and the imbalance has to be addressed before any operational decision can be made cleanly. 1 to 1.5 is the tight band. The firm is solvent on paper, but a single major client paying late can push it underwater, so a tight ratio demands aggressive collection discipline. 1.5 to 2.0 is the healthy operating band. That's where the firm can absorb a normal collection delay or an unexpected expense without scrambling. Above 2.0 sounds strong and often is, but it can also signal that cash is sitting in the operating account doing no work for the firm. At that point, the question becomes whether the surplus should be reinvested in capacity, distributed to owners, or held against a known future obligation. The second ratio measures how long it takes the firm to actually collect what clients owe. Accounts receivable days, also called days sales outstanding, answers a simple question. On average, how long does it take from the day you send an invoice to the day the cash hits the bank account? The formula is accounts receivable divided by annual revenue multiplied by 365. The healthy operating ceiling is 60 days. 30 to 45 days is excellent and means the firm's collection discipline is genuinely working. 45 to 60 is the normal professional services range and doesn't require special action. 60 to 75 is the concerning band. Somebody is letting invoices age out, and the principal needs to be looking at the aging report personally and making the calls. Above 75 days is a problem requiring senior intervention, because at that point, the firm is effectively financing its clients with its own cash and is one bad month from missing payroll. The third ratio shifts from short-term cash to the firm's overall capital structure. Debt to equity is the structural ratio. Total liabilities divided by owner's equity tells you whether the firm is built primarily on the owner's invested capital or primarily on borrowed money. Below 0.5 is conservative, mostly equity funded, very low financial risk, often appropriate for a stable boutique that doesn't need to chase capacity. 0.5 to 1 is the healthy target band for most firms. The capital structure is balanced and the debt service is manageable. 1 to 2 is leveraged, more debt than equity, which is fine when project flow is steady but becomes uncomfortable in a downturn. Above 2 is the high-risk band, where the firm is genuinely fragile. A single significant revenue dip can trigger a covenant breach or a missed loan payment. And once that happens, the bank's interests start overriding the owner's interests in how the firm gets managed. Recap, then we move into fee structures and the cost buildup that determines whether your billings are actually defensible. 5 takeaways on liquidity. First, a profitable firm can still fail from illiquidity. Profit is an accounting concept. Cash is a fact. And the firms that confuse the two miss payroll while the income statement still looks fine. Second, the current ratio target band is 1.5 to 2.0, and anything below 1 means the firm's near-term obligations exceed its near-term liquid assets. Third, accounts receivable days should sit below 60. Above 75, and the firm is structurally at risk of running out of cash regardless of how much work is in the pipeline. Fourth, debt to equity should sit below 1. Above 2 signals genuine financial fragility that a single bad quarter can convert into a covenant breach. And taken together, those 3 ratios are the survival snapshot a banker, bonding company, or buyer will run before doing anything else with the firm. When an architect quotes a fee, the number is only half the decision. The other half is the structure that produces the number, because the structure determines who bears the cost if things don't go as planned. A lump sum says the architect will absorb the difference between the estimate and reality. An hourly arrangement says the client will. A percentage of construction says the fee floats with the project. And an hourly with cap arrangement says risk shifts at a specific dollar threshold. Most architects pick a structure out of habit or because the client asked for it, without consciously deciding which party should bear the scope risk. The result is firms that quietly absorb hundreds of thousands of dollars of uncompensated work because they signed a lump sum contract on a scope nobody had pinned down. Start with the four main structures and what each one actually transfers. 4 structures and what each one transfers. A lump sum is a fixed fee for a defined scope, and the architect carries the risk because if the work takes longer than estimated, the firm absorbs every extra hour. Hourly billing invoices the client for actual hours worked, which means the client bears scope risk. If the project takes twice as long, the client pays twice as much. Percentage of construction sets the fee at a stated percent of construction cost, so the fee floats with project size. That splits the risk in a peculiar way because the architect gets paid more when construction costs go up, but doesn't necessarily do proportionally more work. Hourly with cap is a hybrid. The client pays for actual hours up to a stipulated maximum, and above the cap, the architect absorbs every additional hour. Which structure to use in any given situation is mostly a question of how much you actually know about the scope at signing. The decision rule is mostly about scope certainty at the moment of signing. When the scope is clear and the program is well defined, a lump sum is appropriate. The risk is manageable, and the client gets the certainty they're paying for. When the scope is genuinely uncertain or the project is evolving, hourly without a cap is the right answer. The client bears the scope risk they created by not pinning the project down. When the client wants a budget cap, but the scope is still unclear, hourly with cap is the balanced answer. The architect bills time normally up to the cap, and the cap protects the client from a runaway estimate. Percentage of construction makes sense on large projects where it's the market norm and tracks the project size automatically. And with a new client where the scope is still forming, hourly is the safe answer until you've worked together long enough to understand how they manage scope. The cost of getting this wrong becomes visible the moment something changes after contract signing. The structures behave very differently under stress. Take a typical disruption. Scope grows by 20% after contract signing. Under a lump sum, the architect absorbs every extra hour unless a written change order is negotiated, which is why disciplined change order practice on every scope addition is the single most important habit a lump sum firm can build. Under hourly, the client simply pays for the additional hours as they're worked. Same dynamic when the project takes 6 months longer than planned. Under lump sum, the architect absorbs the extended services cost, while under hourly, the client pays for the time. Construction cost changes don't move the fee in either structure, but they do consume firm capacity, which means a lump sum firm running a project that drags out can find itself underwater on margin even though the contract value never moved. Hourly demands its own discipline: detailed, defensible time records and transparent invoices. Because the trade-off for shifting scope risk to the client is that every billed hour has to survive scrutiny. The pattern that ties all of this together is the principle behind the choice. The fee structure is the risk allocation, and there is no separation between the two. A lump sum transfers scope risk to the architect. An hourly arrangement transfers it to the client. Percentage of construction splits it along the project size dimension, and hourly with a cap shifts the risk at a stated dollar threshold. The right choice is dictated by which party is better positioned to manage the dominant uncertainty in the project. And for almost every architecture engagement, the dominant uncertainty is scope. When the architect controls scope clarity, meaning the program is defined and the deliverables are clear, a lump sum is a fair allocation. When the client controls scope clarity, meaning the program is evolving or the requirements are likely to change, hourly is the fair allocation, because making the architect carry that uncertainty for a fixed price is asking the firm to subsidize the client's indecision. Recap, then the next layer of the conversation: how to actually build the fee from the bottom up. 5 takeaways on fee structures. There are 4 main structures architects use: lump sum, hourly, percentage of construction, and hourly with a cap, and each one allocates risk to a specific party. Lump sum puts scope risk on the architect. Hourly puts it on the client. Percentage splits it along the size dimension, and hourly with cap shifts it at a stated threshold. The decision rule is to match the structure to how much scope certainty exists at the moment of contract signing. Defined program means lump sum is fair. Evolving program means hourly is fair. Any lump sum engagement demands ruthless change order discipline on every single scope addition, because that is the only mechanism that protects the firm from absorbing uncompensated work. And the underlying principle is direct. The fee structure is the risk allocation, and a firm that picks the wrong structure ends up funding the client's uncertainty out of its own margin. Every architect has watched a colleague quote a project off the top of their head, pulling a number from a similar job they remember, adjusting it slightly for the size of the new one, and sending the proposal that afternoon. The number always feels reasonable in the moment, and it's almost always wrong, because the human brain is bad at estimating professional services hours and worse at remembering how many hours a past project actually consumed once you strip out the cost overruns nobody talked about. The cost buildup method is the discipline that prevents this. You estimate the labor cost to actually deliver the project, layer on the overhead the firm requires to operate, and add a profit margin appropriate to the market. The output is a defensible fee that you can negotiate from, audit later, and learn from when the actual hours come in over or under. Start with the formula. 3 layers stack on top of direct labor to produce the fee. The formula stacks 3 layers on top of direct labor. Direct labor is the raw salary cost of the people doing the work, staff hourly rates multiplied by the hours you estimate they'll need. Overhead is everything else the firm requires to operate: rent, software, benefits, principal time, administrative staff, insurance, the entire indirect cost structure of running an architecture practice. Overhead is captured as a multiplier on direct labor, and a typical architecture firm runs overhead between 140 and 180%. Direct labor plus overhead equals total cost. Profit is the margin you apply on top of total cost to compensate the firm for the risk it takes and the capital it deploys. 10 to 15% is a common professional services range. Add the profit to the total cost, and you have the fee that delivers the project at a healthy margin, which is the number you should be quoting. Let me run a concrete example through the formula so the moving parts are visible. Take a project estimated at 2,000 hours of staff time at a blended rate of $45 an hour. Step 1. Direct labor is 2,000 hours times $45, which is $90,000 of raw staff cost. Step 2. Overhead at 150% multiplies the labor by 1.5, adding $135,000 of indirect cost. Step 3. Total cost is direct labor plus overhead, $225,000 to deliver the project. Step 4. Profit at 15% on total cost is $33,750 of margin. Step 5. The fee is total cost plus profit, $258,750. As a cross-check, the net multiplier on this engagement is 2.875. Direct labor of $90,000 multiplied by the net multiplier produces the same fee figure, which is how you confirm the build-up math is internally consistent. The variables in this formula are the levers the firm actually controls. 4 levers sit inside the formula, and each one moves the fee in a different way. Estimated hours is the variable most architects get wrong. It's driven by scope clarity, the experience of the team you'll actually assign, and your historical data on similar projects. Without historical data, hours estimates are guesses with a budget number attached. Labor cost is shaped by the staffing mix you assign. A junior-heavy team produces a lower labor cost but may need more hours, while a senior-heavy team produces a higher rate but typically fewer hours. Overhead rate is set at the firm level by how disciplined the practice is about indirect spending. Firms that let rent, software, and admin creep upward see their overhead multiplier rise and their competitiveness erode. And profit margin is the variable most exposed to the market. Competitive pressure during a slow cycle compresses it, while a strong reputation in a busy market expands it. When firms skip the build-up math, the consequences are concrete, and they show up on the income statement. Rivera Design Group priced a university science building using gut feel. They referenced a project from their portfolio, adjusted the fee slightly upward for the larger scope, and proposed $420,000. The actual project consumed 4,200 hours, and the actual cost to deliver it was $577,500. The net loss to the firm was $157,500 on a single engagement. The cause was identifiable in hindsight. The comparable project they referenced was from 8 years earlier, 25% smaller in floor area, and had a substantially simpler lab program with no specialized fume hood or vibration isolation work. A cost buildup applied to the new project, with hours estimated from a current task breakdown, would have produced a fee proposal much closer to the actual cost. And if the client had refused it, the firm could have walked away from the engagement rather than absorb the loss. Recap. Then the next discussion moves from how to price the work to how to keep the firm liquid while it gets paid. 5 takeaways on cost buildup. The formula is direct labor plus overhead equals total cost. Then total cost plus profit equals fee. 3 layers stacked on a labor hour estimate. The typical architecture firm runs overhead between 140 and 180% of direct labor, with a profit margin of 10 to 15% on total cost. The cross-check is the net multiplier. Direct labor times the multiplier should produce the same fee the buildup produces, and if the two methods disagree, the math has an error. The 4 levers inside the formula are estimated hours, the labor cost driven by staffing mix, the firm's overhead rate, and the profit margins set by the market. And the most expensive recurring error in pricing is underestimating hours, which is why historical data on actual versus estimated hours by project type is the single most valuable artifact a firm can maintain over time. Percentage-based fees are the structure most architects grew up with, and the structure most clients expect. The formula is simple. Fee equals construction cost times a percentage. Everyone in the room understands it, it scales with project size, and it is easy to benchmark against the market. That simplicity is exactly why architects keep choosing it, and exactly why it can be the wrong choice. The incentive built into a percentage fee is that your compensation rises when construction cost rises, and falls when construction cost falls. That sounds fair until you think through what it means. A client who hires you for design intelligence is paying you a fee that drops every time you save them money. The architect who spends 40 hours finding a smarter, cheaper assembly gets less for the work, not more. The structure rewards quantity of construction, not quality of design, and that misalignment is the trap. Let me show you the typical ranges by project type, because percentage fees are not one number. They vary by complexity and design intensity. 6 common project types and the ranges that typically apply. Notice that the percentage is not driven by total project size. It is driven by design intensity per dollar of construction. A simple renovation at 8 to 15% looks high until you realize the architect is making detailed decisions about every existing condition, every patch, and every interface with what stays in place. The design hours per dollar of construction are high, so the percent has to be high. Complex new construction lands in the 6 to 10 range because the work scales more efficiently with size. Simple new construction, warehouses, repetitive buildings, sits at 4 to 8 because each square foot demands relatively little design effort. Large institutional projects ride scale efficiencies down to 5 to 8%, but the dollar amount of the fee is large because the project is large. High-end residential is the steepest range, 10 to 18%, because the architect is essentially custom engineering every surface. And interiors-only projects sit at 10 to 15 because the documentation is dense and the cycle is fast. The percentage you negotiate should reflect where your specific project lives in this spectrum, not a default firm-wide number. Once you understand the ranges, the next question is what percentage fees actually do well and what they fail to do. The advantages of percentage fees are real, and the disadvantages line up against them one for one. Simple to calculate means everyone understands the formula. But a building that requires twice the design effort at the same construction cost yields the same fee, so simplicity hides effort. The fee scales with the project, which sounds fair, but the scaling runs the wrong direction for clients hiring you to save them money. You bring in a cheaper structural system, you reduce construction cost by $1 million, and your fee drops by $60,000. The market standard advantage makes the conversation easy to start, but it also means you don't know your actual fee until bidding closes, and if bids come in low, your compensation drops with no change in the work you performed. And the Adjust with Changes feature works only when the project grows in dollar terms. A scope expansion that fits within the original budget produces no additional fee, even though the work is real. Each advantage carries a disadvantage that lives inside the same mechanic. The most dangerous version of these trade-offs is what happens when you do excellent value engineering work. Let me walk through it. Here is the trap, walked from start to finish. An architect working on a percentage fee learns that the construction estimate has come in over the owner's budget. She offers to lead a value engineering effort because that's what a good architect does. 40 hours of focused design work later, she has identified a smarter structural assembly and a finished substitution that hold the design intent while removing significant cost. The construction cost drops by $800,000. The client is thrilled. The project fits the budget, and the design is arguably better than the original. Then, accounting runs the numbers on the fee. At a 6% rate, the firm's compensation drops from $720,000 to $672,000. The 40 hours of value engineering cost the firm $48,000 in lost fee. Repeat that pattern across enough projects, and the firm is staring at bankruptcy. Not because the work was bad, but because the fee structure punished the work. The fixes exist. Negotiate a floor on the fee, charge separately for value engineering hours, use a hybrid structure with a fixed component. But none of those fixes happen automatically. You have to write them into the agreement before you do the work. Let me close with what you need to carry forward about when percentage fees fit and when they bite. 5 things to walk away with. Percentage-based fees calculate the architect's compensation as construction costs times a percent. Simple to explain, easy to benchmark, and the structure most clients expect. The typical ranges run from 4% on simple new construction up to 18% on high-end residential. And the variable that drives the percent is design intensity per dollar of construction, not project size. Every advantage carries a matching disadvantage built into the same mechanic. Simplicity hides design effort, scaling misaligns incentives, market standard pricing leaves you without certainty until bidding closes. The structural problem you must internalize is that value engineering reduces construction cost, which reduces your fee, which means the better you perform for the client, the less the firm earns. If you choose a percentage structure, write the protections into the agreement before the work begins. A floor on the fee, a separate billing channel for cost reduction hours, or a hybrid structure with a fixed base. The fee structure rewards behavior. Choose one whose rewards match the behavior you want to provide. Hourly billing charges the client for the actual hours worked. It is the most transparent structure available to an architect. Every hour logged corresponds to a line on an invoice, and the client can see exactly what they're paying for. Hourly fits situations where the scope is genuinely undefined. Early feasibility studies, investigative work, court-required testimony, design support on a project the owner is still shaping. It fits when speed matters more than predictability, and when the client trusts you enough not to require a cap. But the very transparency that makes hourly defensible is also what makes it dangerous. The client sees every hour, and the client will push back on hours that look excessive, even when the work was necessary. And the moment you accept a not-to-exceed cap without protecting it with scope language, you have written yourself into a fixed fee contract while still tracking time as if you have flexibility. That is the structural trap. Let me walk through how billing rates are built, because the math behind the rate is what determines whether the structure works at all. 2 ways to build a billing rate, side by side, and they converge when the inputs are consistent. The left column is the faster method. Take direct labor cost, which is the hourly salary number from your firm's accounting, and multiply by a target net multiplier. A $50 an hour direct labor cost at a 3 times multiplier yields a $150 billing rate. That single multiplier already absorbs 3 things: the firm's overhead, the target utilization rate, and the target profit margin. That's the whole point of the multiplier. The common mistake is to take the multiplier and then divide by utilization a second time, which overbills the client by a factor that looks reasonable, but isn't. The right column is the explicit buildup. Start from the same direct labor cost, divide by utilization to recover non-billable time, multiply by 1 plus overhead, then multiply by 1 plus profit. The 2 methods produce the same answer when the multiplier reflects actual overhead, utilization, and profit goals. If they diverge, your multiplier is no longer calibrated to the firm's actual economics, and the rate it produces is no longer protecting the margin. With the rate calculation locked in, the next decision is which rate structure to offer the client. 4 rate structures, each fitting a different client and project profile. The single blended rate is the simplest. Every hour bills at the same number regardless of who performed the work. It fits small projects with unsophisticated clients who want a clean invoice and don't care whether the principal or an intern did the drafting. The trade-off is that it underprices senior work and overprices junior work, so it only works when the team mix is stable. Role-based rates are the most common structure in mid-size and large firms. A principal rate, a senior architect rate, a project architect rate, an intern rate. Each rate aligns price with the skill applied, and clients can read the invoice and see that senior decisions cost senior dollars. Named individual rates are the next level of precision. Specific people on the team have specific rates, written into the agreement by name. That structure fits sophisticated clients who want to know that the principal they hired is actually doing the principal-level work. Task-based rates are rare in general practice. A different rate for design hours versus production hours versus construction administration, because it requires the firm to track work type alongside hours. It can incentivize efficiency, but the bookkeeping overhead is significant. Whatever structure you choose, the place hourly fees get destroyed is in the cap clause. Let me show you the 5 traps. 5 traps that turn hourly with a cap into a worse contract than a fixed fee. First, no defined scope behind the cap. The agreement names a not-to-exceed number, but never specifies what work it covers, so every expansion eats your hours, and the client treats the cap as the price for anything they ask. Second, scope creep without a written change procedure means the firm absorbs new work that should have been billed, and principals end up exposed to personal liability when a fee dispute later becomes a lawsuit. Third, applying the cap to total fee, including reimbursables, crowds out billable hours because printing, mileage, and consultant pass-throughs eat the same number you intended to bill labor against. Fourth, assuming 100% utilization produces a cap that runs out early. Billable hours never equal scheduled hours, so the rate calculation must reflect that. Fifth, client write-downs discount legitimate effort at invoice time unless detailed task descriptions and a regular invoicing cadence make every line defensible. The remedy is the same in every case. Write the scope, the change procedure, and the reimbursable treatment into the agreement before work begins, or you will be the one explaining to your insurer why a fee dispute turned into a claim. Let me close with what you need to know cold about hourly billing going into the exam. 5 takeaways on hourly billing. The structure fits situations where scope is genuinely undefined. Early feasibility, investigative work, design support on a moving target, and where the client values transparency over predictability. The rate itself is built as direct labor cost times a net multiplier, and the multiplier is a single factor that already absorbs the firm's overhead, target utilization, and target profit margin. Do not divide by utilization a second time. 4 rate structures cover the practical range: a single blended rate for the simplest engagements, role-based rates for the standard mid-size project, named individual rates for sophisticated clients, and task-based rates for specialized practices. The biggest operational trap is the not-to-exceed cap without defined scope behind it. That structure is a fixed fee in disguise, and unless the agreement names the work the cap covers and a procedure for billing scope beyond it hourly outside the cap, scope creep will consume your margin while the client believes they are paying you fairly. The other 3 places margin quietly disappears are reimbursables that count against the cap, utilization assumptions that ignore non-billable time, and client write-downs on hours that look excessive. Protect against each one explicitly in the agreement. Most architects treat the project delivery method as a procurement decision the owner makes before calling the architect. That framing is exactly backwards. Delivery method is the structural decision that determines the entire project. Who contracts with whom, when the contractor enters the picture, how risk is allocated between owner and contractor and architect, what authority you actually have over the work in the field, and at what point the owner finally knows the price. 2 projects that look identical on paper, same program, same site, same budget, can run radically different schedules, different risk profiles, and different architect roles, depending on which delivery method the owner chose. If you arrive on a project without understanding which method governs it, you are about to make decisions that don't match the contract you are operating under. The exam tests your ability to match method to situation, which means it tests whether you understand the trade-offs each method makes. Let me show you the 5 specific things that delivery method determines, because these are the variables that shift project by project. 5 variables shift with the delivery method, and each one materially affects how you practice. The first is who contracts with whom. In some methods, the owner holds 2 separate contracts with no direct architect-contractor relationship, while in others, a single or multi-party agreement governs all parties. The second is when the contractor enters, sometimes after design is complete, sometimes from the earliest phases providing constructability input. The third is how risk is allocated. Cost overruns, scope changes, and constructability problems fall on different parties depending on the method, and the wrong allocation can leave the architect carrying liability for decisions the contractor should have owned. The fourth is the architect's role and authority, which ranges from independent owner's agent with field authority to one member of a collaborative team with shared authority. The fifth is when the owner knows the price, at bidding, at a guaranteed maximum price agreement, or progressively through the work. Getting any of these wrong sets up the kind of construction administration dispute that ends in a lawsuit. And architects do get sued when the contract structure doesn't match the work being performed. 4 delivery methods cover almost every project an architect will encounter. Let me walk through what each one is built for. 4 methods. four very different structures. Design bid build is the traditional sequential approach. Design is completed, the documents are issued for competitive bidding, and a separate contractor is selected to build. The architect and contractor never share a contract. It is the most familiar method, the one most public projects are required to use, and the one that produces the most adversarial dynamics when problems arise. Design build folds design and construction under a single contract. The owner hires one entity, the design builder, who takes responsibility for both. The architect on a design build project is typically a subcontractor to the design builder, which fundamentally changes the architect's relationship to the owner. Construction manager at risk brings the contractor onto the team during design, then converts to a guaranteed maximum price agreement before construction starts. The owner gets constructability input early and cost certainty before bids. An integrated project delivery is the most collaborative structure, a multi-party agreement where owner, architect, and contractor share risk and share reward through a single document designed to align incentives across all three parties from the beginning. Choosing among these four methods is not arbitrary. 6 factors drive the decision, and each one can push the answer in a different direction. 6 factors, each one capable of changing the answer on its own. Owner sophistication is the first. A first-time owner without internal construction expertise should not be managing 2 separate contracts and adjudicating disputes between architect and contractor. That owner is better served by a design build or CMAR structure that consolidates responsibility. Cost certainty timing matters because the methods produce certainty at different points. Design bid build at bidding, CMAR at the guaranteed maximum price agreement, IPD progressively through the work. Schedule pressure pushes toward methods that allow fast tracking, starting site work and foundations while upper-level design is still being completed, which design bid build does not allow, but CMAR and IPD do. Project complexity drives the value of early contractor input. A complex hospital benefits enormously from a contractor sitting at the table during design. A simple warehouse does not. Risk tolerance asks, who is best positioned to absorb cost, schedule, and constructability risk? And the method should match the answer. And legal requirements can override every other factor. Public projects in many jurisdictions are required by law to use design, bid, build with competitive bidding, regardless of what would be optimal. Let me close with the framing you need to carry into the exam about method selection. 5 things to walk away with. The project delivery method determines 5 concrete variables on every project: who contracts with whom, when the contractor enters, how risk is allocated, what authority the architect actually holds, and when the owner finally knows the price. The 4 major methods you must know are design bid build, design build, construction manager at risk, and integrated project delivery. Each one is built to optimize for a different priority, and none of them is universally best. 6 selection factors drive the choice and they interact: owner sophistication, when cost certainty is needed, schedule pressure, project complexity, risk tolerance, and legal requirements. Any one of those factors can shift the answer, which is why the exam never asks which method is best in the abstract. The exam asks which method fits a specific situation, given the factors described in the question. And the most common shortcut to a correct answer is the legal requirement factor. When the project is public, design, bid, build is often the required method, regardless of what would be optimal. And that constraint usually appears explicitly in the question stem. Design, bid, build is the traditional project delivery method, and for most architects, it is the default mental model unless someone tells them otherwise. Its defining feature is the strict sequence. Design completes first, then the project is competitively bid, then construction begins. Each phase finishes before the next begins, and every advantage and disadvantage DBB produces traces back to that linear order. Competitive bidding works because the documents are complete. The architect's independence is preserved because the contractor isn't present during design. The schedule is the longest of any method because no phases overlap, and change orders pile up in construction because the contractor reads the documents for the first time at bidding rather than during the design that produced them. The same separation that makes DBB work is also what produces a predictable pattern of change order disputes that escalate into lawsuits when the dollar amounts get large. If a question describes construction starting before design is complete, the method is not DBB by definition. Let me walk you through the 3 phases and the contract structure that makes the method behave the way it does. 3 phases, in strict order. Phase 1 is design. The architect completes drawings and specifications under a contract with the owner, with no contractor input during that process. Phase 2 is bid. The owner solicits competitive bids on those completed documents. The architect typically assists in evaluation, and the lowest responsive bidder is selected. Phase 3 is build. The owner signs a separate construction contract with the selected contractor, and the architect performs contract administration during construction. The contractual structure is what makes this work and what creates the predictable failure modes. The owner holds 2 separate contracts, one with the architect, one with the contractor. The architect and the contractor have no direct contract with each other. All communication between them flows through the owner or through the architect acting as the owner's agent during construction administration. That separation preserves the architect's independence. The architect is not the contractor's employee and has no financial interest in construction cost. And it is also what produces the adversarial dynamics when problems arise. The contractor is bidding documents the architect produced without the contractor's input, and when constructability problems surface in the field, the parties tend to blame each other rather than collaborate. The sequence and the 2 contract structure together produce a specific set of characteristics that show up on every DBB project. 6 characteristics define the DBB project experience, and each one traces back to the structure. The architect's role during construction is owner's agent, administering the contract, certifying payment applications, observing the work, and ruling on disputes, performed independently of the contractor because the 2 have no contractual relationship. Contractor selection happens after design is complete, through competitive bidding on the completed documents. That is what makes the price competitive, and it is also why the owner doesn't know the actual price until bidding closes. Price certainty arrives late. The owner commits to design fees and produces complete documents based on an estimate, with no contractual guarantee of construction cost until bids come back. Design changes after construction starts are expensive because every change requires a formal change order, with the contractor entitled to price adjustment and time extension for any work outside the bid documents. Fast tracking is difficult under DBB because the bidding requires complete documents, and partial bids defeat the competitive pricing the method is built around. Contractor input during design is 0, since the contractor isn't selected until design is finished. Those 6 characteristics produce a set of advantages and a matched set of disadvantages. Let me lay them out side by side. 4 advantages, 4 matching disadvantages, each pair driven by the same underlying mechanic. Competitive pricing works because multiple contractors are bidding identical complete documents, and that same completeness requirement is exactly why the schedule is the longest of any delivery method. The phases cannot overlap. Clear roles between design and construction make responsibility easy to assign, and the same separation means the architect doesn't get cost certainty for the owner until bidding closes, well after design fees have been committed. The architect's independence during design is genuinely valuable. No contractor in the room pushing for cheaper details that compromise the design intent. That same independence also means no contractor flagging constructability issues that will later surface as change orders in the field. The method is familiar to every party, every consultant, every public agency. and that familiarity has produced 50 years of adversarial litigation patterns the parties have learned to expect. There is no free lunch. DBB optimizes for competitive pricing, clean rolls, and architect independence, and it pays for those optimizations with a long schedule, late cost certainty, and a high change order count. Methods that produce the opposite advantages, such as CMAR, design build, and IPD, pay opposite costs in exactly the same way. Let me close with what you need to carry forward about DBB for the exam. 5 things to walk away with. The defining feature of design bid build is the strict linear sequence. Design completes, then bidding, then construction, and if a question describes construction starting before design is complete, the method is not DBB. The contract structure is 2 separate agreements, owner with architect and owner with contractor, with no direct contract between architect and contractor, so all coordination flows through the owner. During construction, the architect acts as owner's agent, administering the contract, certifying payments, observing the work, and ruling on disputes, with that authority resting on independence from the contractor. The advantages are competitive pricing, clean role separation, an independent architect, and familiarity to all parties. The matching disadvantages are the longest schedule of any method, late cost certainty, 0 contractor input during design, and a predictable pattern of change orders in construction. The method is not better or worse than the alternatives. It makes specific trade-offs, and the exam tests whether you can match those trade-offs to the situation described. Design build is the delivery method an owner picks when they care more about schedule certainty than they do about controlling the design. 1 contract instead of 2. 1 entity instead of an architect on one side of the table and a contractor on the other. When something goes wrong on a DB project, the owner does not get to watch the architect and the contractor blame each other for a month while the building sits unfinished. They call the design builder, and the design builder owns it. That sounds great if you are the owner. It is a meaningfully different deal if you are the architect, because in DB, you usually do not work for the owner anymore. You work for the design builder. Your client just changed, and most architects who land in a DB partnership for the first time do not realize how much that one change rearranges the relationship. Start with the contract diagram, because everything about how DB works on the ground falls out of it. Read carefully what the contract diagram actually says. The owner has exactly 1 agreement, and it is with the design builder. The architect has exactly 1 agreement, and it is also with the design builder. There is no contract line running directly from the architect to the owner. That is the structural fact that drives every behavior on a DB job. It means the architect's professional duties, standard of care, code compliance, life safety, still attached to the licensed work, but the day-to-day direction, fee negotiation, schedule pressure, and approval authority all come from the DB. The owner is a beneficiary of the architect's professional work, not a counterparty to it. And because the architect's paycheck is signed by the contractor, every conversation about cost versus quality starts from a different power balance than it would on a traditional design bid build project. Now consider the 4 configurations the architect can occupy inside that DB structure, because they are not the same job. 4 configurations, and the difference between them is who carries the risk. In a contractor-led DB, which is by far the most common arrangement, the architect is a sub-consultant. The contractor controls the fee, the scope, and the design priorities, and the architect's ability to push back on a value engineering demand is limited because the contractor can replace them. In an architect-led DB, the architect's firm is the design builder. That sounds appealing. You keep control of the design, but it means the architect's firm is now contractually responsible for the means and methods of construction, and most architecture firms do not carry the bonding capacity or the construction risk insurance to back that up. A joint venture splits the difference. The architect and the contractor form a separate DB entity together, which requires real governance documents and a thoughtful split of profit and liability. And in the in-house model, the design builder simply employs licensed architects on staff, which means there is no separate architecture firm involved at all. Same delivery method, 4 very different jobs. Whichever configuration the architect lands in, the same set of structural consequences shows up the moment the project starts. 4 consequences that nearly every architect coming into DB for the first time underestimates. Budget pressure becomes internal. The contractor may walk in with a target number and tell the architect to design to it, regardless of what the program actually requires, and pushing back means jeopardizing the next job from the same DB partner. Client access gets filtered through the DB. The architect may never sit down with the owner's building committee on their own, which means the design decisions that get made are the decisions the DB is comfortable presenting, not necessarily the decisions the owner would make if they had unmediated access to the architect. Fee negotiation turns adversarial in a way it never is in design bid build, because the contractor's profit margin and the architect's fee come out of the same pool. Every dollar the architect bills is a dollar the contractor does not earn. And here is the consequence architects miss most often. Liability still attaches to the licensed professional. If the building has a defect, the architect can be named in the lawsuit even when the design decision was driven by the DB's cost demand, which is why architects in DB need to maintain their own professional liability coverage and document every direction they push back on. Pull those 4 consequences together, and you have the case for why DB is a genuinely different business, not just a different procurement form. 5 takeaways from design build. First, one contract runs from the owner to the design builder and covers both design and construction. The architect signs separately with the DB, not with the owner. Second, the architect's contractual client is the DB, which changes the day-to-day reporting line even though the architect's professional duties to the public are unchanged. Third, there are 4 common configurations: contractor-led DB, architect-led DB, joint venture, and in-house design. And they assign the construction risk very differently, so know which one you are entering before you sign. Fourth, the owner is trading design control for schedule speed and single source accountability, which is exactly why public agencies and developers on tight timelines reach for DB. And fifth, the architect's professional liability does not disappear just because the DB is making the decisions. Keep separate professional liability coverage. Document every time you formally object to a direction, and treat your pushback trail as the evidence file that will protect you when the building generates a claim. Most architects walking into a CMAR project for the first time underestimate how different it is from anything they have done before. You are not picking a procurement form. You are picking a structure that has quietly become the default for hospitals, courthouses, university buildings, and most complex public work over the last 2 decades. The mechanic at the center of it is the Guaranteed Maximum Price, GMP for short. The construction manager comes in early, sits at the design table, helps the architect understand what is buildable and what is going to be expensive, and then, at some point, usually near the end of design development or early into construction documents, they commit to a maximum price. If the actual cost lands above that number, the contractor eats the difference. If it lands below, the savings are typically shared. That single mechanic is what makes CMAR behave so differently from a traditional bid-build job, and it is what the exam tests. Start with the precise definition of the GMP, because most of the CMAR questions on the exam are really GMP questions in disguise. The GMP is a contractual ceiling. The CMAR looks at the drawings as they exist at a defined milestone, usually the end of design development or the early construction document phase, when the design is detailed enough to be reliably priced. And they tell the owner, I will deliver this building for no more than X dollars. If the actual cost of the work plus the contractor's fee comes in above that ceiling, the CMAR absorbs the overage out of their own profit. If the actual cost lands below, the savings are not pure contractor profit. They are typically shared with the owner under a split that was negotiated up front, often 50-50, sometimes weighted toward the owner. That single feature aligns incentives in a way that bid build never does, because the contractor only benefits from cost-saving ideas if they also share that benefit with the owner. The GMP is also why timing matters so much. Set it too early, when drawings are still incomplete, and the contractor has to carry an enormous contingency that the owner ultimately pays for. Set it too late, when the design is already locked in, and you have lost the contractor's value engineering input. The GMP does not appear out of nowhere. It is the output of a structured, two-phase process the owner is buying when they choose CMAR. CMAR is really two contracts wrapped into one engagement. In the pre-construction phase, the CM is being paid a fixed or hourly fee to sit at the design table and contribute. They tell the architect that the curtain wall detail being drawn is going to cost 3 times what the cladding budget allows. They flag that the steel package being specified is on a 16-week lead time that will not fit the schedule. They run constructability reviews and price the drawings at progressively more detailed milestones. That work happens before any commitment to actually build, and the owner pays for it as an advisory service. Then at the GMP milestone, the relationship converts. The CM signs on for the construction phase under a cost-plus-fee arrangement capped at the GMP, and from that point forward, they are no longer just an advisor. They are the contractor, on the hook for delivery. The architect's contract with the owner does not change at either phase boundary. That is the structural feature that distinguishes CMAR from design build. Once the GMP is set and construction starts, 3 outcomes are possible, and the exam loves to test which party bears the consequence in each one. 3 outcomes, and they are the 3 the exam will ask about. If actual cost lands below the GMP, the savings are shared with the owner under whatever split the parties negotiated when they signed. Often 50-50, sometimes more favorable to the owner on public projects. If actual cost lands exactly at the GMP, the CMAR earns the fee they were promised, and the owner pays exactly what they expected to pay. And if actual cost lands above the GMP, the CMAR absorbs the overage. They eat it out of their profit. That last scenario is the at-risk part of construction manager at risk. The contractor has put their own fee on the line as the guarantee. There is one subtlety the exam likes to test, and getting it wrong on a real project can drag the architect into a lawsuit. The GMP can be amended for legitimate, owner-driven changes, added scope, design changes the owner requested after the GMP was set. What it cannot be amended for is the contractor's own bad estimating or productivity problems. And a contractor who tries to claim those as owner-driven changes will sue the architect to support the argument. Add up the GMP mechanic, the 2 phases, and the architect's preserved relationship with the owner, and you can see why owners with complex programs reach for CMAR over the alternatives. 5 reasons owners with sophisticated programs reach for CMAR. The first is early contractor input. Having the builder at the design table before drawings are complete means constructability problems get caught while they are cheap to fix. The second is price certainty before drawings are finished, because the GMP caps the owner's exposure even though the design is still being refined, which is something neither bid build nor traditional negotiated work can offer. The third is fast tracking, because the contractor is already engaged and the owner can start excavation while interior packages are still being detailed. The fourth is the architect-client relationship. Unlike design build, where the architect works for the contractor, in CMAR, the architect retains a direct contract with the owner, so design control stays with the owner and the architect together. And the fifth is the shared savings split, because the CMAR is incentivized to come in under the ceiling, and that single financial detail aligns the contractor's interest with the owner's in a way bid build never does. Pull all of that together, and the value proposition of CMAR becomes obvious. And so does the reason it is the default for so much complex public work. 5 takeaways from CMAR. First, The contract structure runs two separate lines from the owner, one to the architect, one to the construction manager, which is structurally different from design-build, where the owner has only one contract. Second, the pre-construction phase is an advisory engagement in which the CM is paid a fee to sit at the design table and contribute constructability and cost feedback while drawings are still developing. Third, the construction phase converts to a cost-plus-fee arrangement capped at the guaranteed maximum price, and that ceiling is the defining feature of the method. Fourth, the GMP sets up three outcomes the exam will test. Under the ceiling and savings are shared, at the ceiling and the contractor earns the fee, over the ceiling and the contractor absorbs the overage. And fifth, the architect keeps a direct contract with the owner throughout, which is the single biggest reason complex owners pick CMAR over design-build. IPD, Integrated Project Delivery, is not really a procurement form. It is a legal and financial restructuring of how the owner, the architect, and the contractor relate to one another. Instead of separate contracts that point in opposite directions, the three parties sign one agreement. The standard form is the AIAC 191, the multi-party agreement. Profit is pooled and put at risk. Decisions are made jointly. And, this is the part most architects find genuinely strange the first time they encounter it, the parties typically waive their right to sue each other for anything except gross negligence or willful misconduct. The premise is that if you remove the adversarial structure that drives most construction disputes, the team will make better decisions because no one is protecting themselves from the others anymore. The exam tests IPD heavily for exactly that reason. It is the most different from traditional practice, and the structural differences are what get asked about. Start with the contract itself, because the multi-party agreement is the mechanism that makes everything else about IPD work. The AIAC 191 is the standard form, and it does something no other construction contract does. It puts the owner, the architect, and the contractor on the same piece of paper as co-signatories. There is no owner-to-architect contract on one side and owner-to-contractor contract on the other. There is one agreement, signed by all three. Inside that agreement, three structural features make IPD work. The first is open book accounting. All costs are transparent to all parties with no hidden contractor markup and no surprise consultant fees. The second is joint decision-making. Major project decisions require consensus across the three parties rather than the owner deciding alone. The third is the mutual waiver of claims, which means the three parties give up the right to sue each other except for gross negligence or willful misconduct. Small claims, schedule disputes, scope disagreements are all required to be resolved inside the team rather than in court. That waiver is the structural feature that makes the rest of IPD possible. Because without it, the open book accounting and the joint decision-making become legal liabilities. On top of the legal structure sits the financial structure, and that is where most of the exam's IPD questions actually live. 6 defining features, and the exam will test you on any one of them. The multi-party contract is the legal mechanism. One piece of paper, 3 signatories, all engaged from the very first conceptual conversation rather than phased in after the design is half complete. Shared risk and shared reward are the financial mechanism. The parties agree on cost and schedule targets up front, put a portion of their profit at risk against those targets, and the pool either grows or shrinks based on outcomes. Collaborative decision-making changes the governance of the project. The owner cannot unilaterally direct the architect or the contractor on the major issues. The team has to reach consensus. Open book accounting means there are no hidden margins. Everyone sees what everyone else is being paid and what the actual costs are. And the waiver of claims is the cultural mechanism. By giving up the right to litigate small disputes, the parties commit to resolving problems inside the team rather than escalating them. Each feature on its own would be unusual. Stacked together, they describe a completely different way of building. The financial mechanism, the pooled at-risk profit, is the part the exam loves to ask about because it is what genuinely aligns the team's incentives. 3 outcomes, and the structural beauty of IPD is that every party experiences each outcome together. If the project beats its cost and schedule targets, all 3 parties, owner, architect, contractor, earn a bonus from the shared savings pool. If the project lands on its targets, all 3 earn the base compensation they signed up for. And if the project misses its targets, all 3 share the losses, which are drawn from the at-risk portion of each party's profit. The architect cannot earn a windfall while the contractor takes a loss, and the contractor cannot earn a bonus while the architect's fee is squeezed. That is, the alignment of incentives that IPD is built to produce. It is also the reason that target value design becomes practical under IPD in a way it never quite is under other delivery methods. When everyone shares the savings, everyone is willing to question whether a feature is worth what it costs. Given all of those advantages, you would expect IPD to be everywhere by now. But in practice, it remains rare, and the exam will want you to understand why. 4 reasons IPD has not displaced design build or CMAR as the default for complex projects. First, it requires an unusual level of trust among the 3 parties, owner, architect, and contractor, that is hard to manufacture, especially when the team is being assembled for the first time. Most successful IPD projects involve parties that have worked together before. Second, public agencies frequently cannot legally enter into an agreement that waives claims or shares a risk pool. Their procurement rules and their fiduciary duties to taxpayers prohibit it, which means a huge segment of the construction market is structurally closed to IPD. Third, the insurance products that cover multi-party agreements are still evolving. The waiver of claims complicates how professional liability and general liability policies respond, and underwriters charge for that uncertainty. And fourth, the owner has to give up unilateral decision authority, and a surprising number of sophisticated owners simply cannot stomach that trade. They would rather pay the premium of an adversarial structure than share decision rights with their contractor. Wrap up the structural picture, and you have a delivery method that the exam treats as the gold standard of collaboration, even though the market still treats it as the exception. 5 takeaways from integrated project delivery. First, IPD is built around a multi-party agreement, typically the AIAC 191, that puts the owner, the architect, and the contractor on one contract as co-signatories instead of in separate, opposing relationships. Second, the financial heart of the method is shared risk and shared reward. Profit is pooled and put at risk against cost and schedule targets agreed up front, so all 3 parties win or lose together. Third, the procedural features that support that financial structure are early involvement, joint decision-making, and open book accounting across the entire team. Fourth, the mutual waiver of claims is the cultural feature that makes the rest possible. By removing the right to litigate small disputes, the parties commit to resolving problems inside the team. And fifth, IPD is the most exam-testable delivery method precisely because it differs most sharply from traditional practice. So know the 6 structural characteristics, the 3 risk-reward outcomes, and the multi-party agreement form by name. 4 delivery methods, and the exam will test you on which one fits which owner priority. Recommending the wrong one on a real project can leave the architect personally liable for risks the original fee never accounted for, and the resulting lawsuits cost firms millions. Design Bid Build optimizes for lowest first cost on a clearly defined scope. Design Build optimizes for schedule and single source accountability. CMAR optimizes for contractor expertise during design without losing the architect-owner relationship. Integrated project delivery optimizes for collaboration and aligned incentives on complex projects where the team can be trusted. The trap most candidates fall into is treating these 4 as interchangeable, and they are not. Each one solves a different problem, and each one creates a different set of consequences for the architect. The questions the exam likes to ask are framed as owner priority scenarios. The owner wants X, which delivery method fits? Or, the architect's client is the contractor, which delivery method must this be? Or, price was fixed before drawings were complete, which two methods are possible? Walk through the structural differences in a compact matrix, and the pattern becomes easy to remember. This is the single most tested distinction in Section 2.5, so commit it to memory. Design, bid, build. The owner holds two separate contracts, one with the architect and one with the general contractor. The architect's client is the owner. The contractor is selected through competitive bidding after the design is essentially complete. Design, build. The owner holds one contract with the design builder, and the architect's contractual client is the design builder, not the owner. The contractor is engaged from the very start of the project. CMAR. The owner holds two separate contracts, just like DBB, but the construction manager is brought in during the design phase rather than after bidding, and the architect's client remains the owner throughout. IPD. The owner, the architect, and the contractor all sign one multi-party agreement together. The architect's client is essentially the team rather than any single party, and all three are engaged from project inception. Notice that the question, "Who is the architect's client?" gives you the delivery method on its own. Owner means DBB or CMAR. Design builder means DB. Team means IPD. Layer in the timing of price certainty and the distribution of risk, and the second high-yield comparison snaps into focus. Price certainty timing is the second high-frequency exam axis, and it lines up with risk in a predictable way. Under design, bid, build, the price is not known until bids come back at the end of design. The owner carries the risk of cost surprises all the way through and only learns whether the budget is real when the envelopes get opened. Under design, build, the price is committed early, often before the drawings are fully developed. The design builder is willing to absorb design stage risk in exchange for controlling both halves of the work, which is why owner risk is rated low. Under CMAR, the GMP typically lands near the end of design development or into early construction documents. The owner gets a price commitment well before drawings are complete, but only after enough detail has been developed for the construction manager to price reliably. Under IPD, there is no single price certainty moment. The team works against shared cost and schedule targets that evolve collaboratively, and the risk is distributed across all parties through the at-risk profit pool. Fast tracking, meaning overlapping construction with design, is difficult under DBB because the sequential bid creates a bright line. It is easy under the other three because the contractor is on board early enough to start work. Once those two axes are locked in, the decision framework, which method for which owner, almost answers itself. This is the decision framework, and it maps owner intent to delivery method directly. An owner who wants the lowest first cost on a clearly defined scope reaches for design, bid, build. That is the textbook use case, and it is why public agencies that have to take the lowest qualified bid default to it. An owner who wants single-point accountability, where they have exactly one party to call when something goes wrong, reaches for design, build. An owner who wants contractor input during design, but does not want to give up their direct relationship with the architect, picks CMAR. That combination is the entire reason the method exists. An owner who wants maximum collaboration and is willing to share both risk and reward to get it, picks IPD. If the dominant priority is schedule speed, DB and CMAR both fast-track well. DBB does not. And if the dominant priority is maximum design control all the way through construction documents, DBB and CMAR both preserve the architect-owner relationship. The exam scenarios will hand you one or two of these priorities and ask you to identify the method, and you should be able to answer in seconds. Test yourself with the 4 high-frequency exam patterns before moving on. Test yourself on these 4 scenarios. In the first scenario, the architect's contractual client is the contractor, which is design-build by definition because it is the only method in which the architect does not contract with the owner. In the second scenario, the price was fixed before the drawings were complete, which points to either design-build, where the price is committed very early, or CMAR, where the GMP locks in near the end of design development. In the third scenario, all parties sign one contract with claims waived, which is integrated project delivery, full stop. The multi-party agreement and the mutual waiver of claims are unique to IPD and are the structural features the exam uses to identify it. In the fourth scenario, 2 separate contracts are signed with the owner, and the contractor is brought in during design rather than after bidding, which is CMAR. DBB also has 2 separate contracts, but the contractor comes in after bidding, not during design. If you can answer those 4 cleanly, you have the Section 2.5 material at exam strength. Close with the takeaways, and you have the comparison locked in. 5 takeaways from the delivery method comparison. First, the question, who is the architect's client, identifies the method with near-perfect reliability. Owner means DBB or CMAR, design builder means DB, and multi-party team means IPD. Second, the multi-party agreement with claims waived pattern is unique to IPD. If a question mentions either feature, the answer is IPD. Third, the timing of price certainty maps cleanly. Late under DBB once bids come in, early under DB before drawings are complete, and mid under CMAR when the GMP locks in near the end of design development. Fourth, fast tracking, overlapping construction with design, is easy under DB, CMAR, and IPD, and structurally difficult under DBB because the bid creates a sequential bright line. And fifth, the exam frames the decision as owner intent. Lowest cost, fastest schedule, single accountability, or maximum collaboration, each map to a specific method. And a candidate who has internalized these mappings can answer Section 2.5 questions in seconds rather than minutes. Every project carries risk. Every project. The question on a licensing exam and the question in your conference room when a contract is being negotiated is never whether risks exist. It is who bears them, who pays when they hit, and whether you understood the answer before you signed. Architects get sued, lose personal assets, and watch their firms slide into bankruptcy over this exact failure. Not because they made a design mistake, but because they signed a contract that quietly transferred someone else's risk onto their balance sheet and never priced it into the fee. A starting point on the April 2026 exam update, NCARB now tests risk identification and mitigation, not opportunity and reward. That shift matters. It tells you what they expect a licensed architect to be able to do at the contract table. Start with the categories, 6 of them, each one with a typical bearer. 6 categories, and the bearer for each one is the answer the exam will expect, unless the contract changes it. Scope risk lives in your fee structure. Lump sum work that grows without a change order is scope risk you absorbed for free. Schedule risk is shared by default, but a contract clause that gives the owner liquidated damages and you nothing for delays is schedule risk you just took on alone. Cost risk shifts with delivery method. Design bid build leaves the owner exposed to bid day surprises, while design build or guaranteed maximum price contracts pull cost risk onto the entity holding the GMP. Design risk is yours. That's what professional liability insurance exists for, and it is non-delegable. Construction risk belongs to the contractor, which is why you observe rather than supervise, and why means and methods stay on their site of the wall. Site and regulatory risk both default to the owner side. Differing site conditions clauses in AIAA 201 cover the unknowns, and code or permit shifts land on the project, not on you personally. Memorize the default. Then read every contract you sign with the assumption that the other side is trying to move one of these defaults onto you. Knowing who bears the risk is only half the job. You also need a strategy for handling the ones you cannot offload. 4 strategies. Every risk on every project gets one of them, whether you assigned it consciously or not. Avoidance means walking away. A high-rise structural concept from a firm that has only done houses is a project to decline, not a project to take and figure out as you go. That's how malpractice claims start. Transfer means shifting the risk to a party better positioned to carry it. Professional liability insurance transfers the financial cost of a covered claim to the carrier. Indemnification clauses transfer specific exposures between owner, architect, and contractor. A structural consultant carrying their own insurance transfers structural design risk off your balance sheet. Mitigation means reducing the probability that a risk will hit or the severity of impact if it does. Quality control procedures, peer review of complex details, written confirmation of every owner decision, those are the daily acts of mitigation. And acceptance means you have looked at the risk, decided it is small enough or remote enough to live with, and you have priced contingency into the fee to cover it if it materializes. Acceptance without contingency is denial, and denial is the most expensive strategy on this list. These strategies only work if you can spot when a contract is silently moving risk onto you. Here are the red flags. 6 clauses, each one a quiet transfer. Owner-supplied program details that you sign off on as verified pull site and scope risk into your design liability. If the owner gave you a wrong setback and you stamped drawings against it, the design risk now belongs to you, regardless of where the bad data started. Fast-track schedules with no float consume schedule risk before the project even begins, because there is nowhere in the timeline to absorb a code review comment or a long lead item delay. Reimbursable expense caps that are unrealistic mean you eat the overage out of the fee, which is cost risk you accepted without a contingency. Broad indemnification turns you into the insurer for claims you did not even cause, transferring third-party risk onto your policy and sometimes beyond what your policy will cover. Certification language inflates your exposure beyond standard of care, and warranties promise outcomes no insurer covers. The absence of a limitation of liability clause turns what should be a capped exposure into an unlimited one, with your firm's existence riding on a single claim. Every one of these clauses is negotiable, and every one has bankrupted firms before. Read every contract assuming one is hiding in it, because in almost every contract one is. Pull it together. Risk allocation is a contract decision, not a discovery after the fact. 5 takeaways from this section. First, the question is never whether risks exist on a project. They always do. The question is who bears them, who pays when they hit, and whether you understood the answer before your signature went on the contract. Second, 6 categories of risk each have a default bearer under standard AIA documents, and any clause that moves a default onto you is a clause you need to price, negotiate, or refuse. Third, every risk gets exactly one of 4 treatments: avoid it, transfer it, mitigate it, or accept it, and the choice should be deliberate, not accidental. Fourth, acceptance without contingency is the most expensive strategy on the list because it pretends the risk does not exist until the day it shows up as a claim. And fifth, risk allocation is a contract decision. It belongs in the negotiation, in writing, with both sides understanding what they agreed to. Not in the conference room 3 years later when the lawyers are trying to figure out who is going to pay. Most architects skim their owner-architect agreements. You should not. One word in a contract has bankrupted firms whose work was technically sound. A principal at a mid-sized studio signed a high-rise condo agreement that contained a single sentence: "The architect shall warrant that the design is free from all defects." 3 years later, water infiltration appeared, and the cause was a manufacturer's installation defect, not anything the firm did wrong. The professional liability carrier denied coverage. Their policy covers negligent errors and omissions, while the warranty clause created contractual liability beyond the standard of care, which is exactly what the policy does not cover. Settlement: $1.2 million, paid out of personal assets. That is what a single word in a contract can do to your firm. Start with the words themselves. Which ones are red flags, and what to substitute when you redline? 5 words to circle in red every time you see them in a draft. Warrant means guarantee, and a guarantee exceeds standard of care, which is the legal threshold your insurance is built around. Substitute represents or opines. Certify is an absolute statement. The moment you certify something, you are personally liable if it turns out to be wrong, even if you were careful. So substitute the phrase, "to the best of my knowledge," which preserves the meaning without inflating the liability. Insure is a guarantee of outcome, and architects do not guarantee outcomes. We apply reasonable professional effort. So substitute use reasonable efforts. Error-free is the impossible standard. No design is ever error-free, and no honest architect should promise one. Substitute consistent with standard of care. The words all and any create unlimited scope. For example, all permits or any code requirement, which converts a defined deliverable into an open-ended commitment. Replace them with a specific listed scope. These are not stylistic preferences. They are the difference between a covered claim and a denied claim. Beyond individual words, certain whole provisions are structurally dangerous. Here are the big 5. 5 provisions, each a contract paragraph that needs a response before you sign. Broad indemnification is the silent killer. It makes you the insurer for someone else's negligence, and most professional liability policies exclude contractual liability that goes beyond your own negligent acts, errors, or omissions. Always limit indemnification language to your own negligence. No limitation of liability means a single claim could exceed everything your firm is worth, so cap it at the fee or at insurance limits. A consequential damages waiver is the difference between paying for the cost to fix a defect, which is reasonable, and paying for the owner's lost rental income for 3 years, which is not. Always negotiate a mutual waiver. Unrealistic schedules force errors. They are not a heroic challenge. They are a quality control failure waiting to happen, and they show up in claim histories. Negotiate timelines that are grounded in actual deliverable volume. And certification requirements need to be read as if every word will be tested in court. Because if there is a dispute, they will be. Limit the scope of what you certify, and use defensible language. None of these provisions are acceptable as drafted, and every one of them is negotiable. Certification is the trap that catches the most architects. Here is what acceptable language looks like next to what gets people sued. 2 columns, same situations, same general intent, and radically different liability exposure. On the acceptable side, I observed construction and found it in general conformance with design intent. That describes what you did and what you found, the legal threshold under standard of care. On the dangerous side, I certify the building is free from defects. You cannot certify that. No architect can. And if you sign that language and a defect later appears, the contract created the liability. To the best of my knowledge, the design meets applicable codes is honest, defensible, and preserves your insurance coverage. I warrant the building will comply with all laws is a guarantee no insurance policy in the country will cover. Based on my observations, substantial completion has been achieved aligns with AIAA 201, which makes substantial completion an architect's professional judgment. I certify the building is complete and ready for occupancy, pulls you across the line into the building official's role, and creates exposure you cannot insure against. The pattern is consistent. Describe what you did, qualify what you found, and never make absolute statements. Pull it together. Bad words and bad provisions create liability your policy will not catch. 5 takeaways. First, words like warrant, certify, insure, and error-free are contract terms that exceed the standard of care your insurance is built around. Substituting represents, to the best of my knowledge, reasonable efforts, and consistent with standard of care is one of the highest impact risk moves you can make. Second, professional liability policies cover negligence, not contractual guarantees. A clause that creates liability beyond negligence can void coverage on a claim that would otherwise have been paid. Third, indemnification language must be limited to your own negligent acts, errors, or omissions. Broader exposure is broader than what your policy will cover. Fourth, every contract should cap your liability at the fee or at insurance limits and include a mutual waiver of consequential damages, which keeps a single claim from reaching lost profit territory. Fifth, acceptable language describes what you did and qualifies what you found, using observation, general conformance, and to the best of my knowledge, while dangerous language makes absolute statements no architect can honestly stand behind. Most owner-architect agreements include an insurance article, and most architects skim it. That skim is the moment a contract obligation gets created that the firm's actual insurance program cannot satisfy. Coverage limits the policy does not carry, additional insured status the policy does not allow, or endorsements the carrier will not write. A contract requirement your policy cannot meet is, in practical terms, a contract you cannot perform. Before you sign, your broker needs to see the insurance article every time. Not after the contract is countersigned, and not after the claim hits, before. The cost of broker review is a single email, while the alternative is a coverage denial on the day you need the policy most. Start with what is standard. 4 coverages, 4 typical limits. 4 coverages, and each one protects against a different category of claim. Professional liability, or PLI, is the central architect's policy. It covers negligent design errors and omissions, typically at limits between 1 and 2 million per claim. This is claims-made coverage, which means the policy that pays is the one in force when the claim is reported, not when the work was done. That detail matters when you retire, sell the firm, or change carriers. And tail coverage is what bridges the gap. Commercial General Liability, or CGL, typically writes at 1 million per occurrence and covers bodily injury and property damage from non-professional causes. Someone trips in your office, a server gets dropped on a laptop, an event in the lobby goes wrong. CGL is occurrence-based, not claims-made. Workers' compensation is mandatory in nearly every state, with limits set by statute, and covers employee on-the-job injuries, including the principals if they are paid as employees. Auto liability typically writes at 1 million, covers vehicle accidents, and matters more than you might think if any employee ever drives to a job site on the firm's behalf. Know these 4. They are the baseline most contracts will ask you to confirm. What about the contracts that ask for more than this, sometimes much more? Here is how to handle the unreasonable requirements. 4 requirements that show up in owner-drafted agreements and shouldn't be accepted as written. A 10 million professional liability limit on a small project is disproportionate to the project size and fee, and frequently the market simply does not write that limit for a firm of your size at a price that makes economic sense. Negotiate a lower limit, or have your broker provide a letter explaining market availability. Naming the owner as additional insured on the errors and omissions policy is the classic owner ask that most carriers will not allow because professional liability is designed to protect the policyholder, not the third parties who are the typical claimants. Explain that this is not standard for E&O and offer general liability additional insured status instead, which is standard. Primary and non-contributory language can conflict with policy terms. Most policies are written to be excess of other available coverage, not primary, and an agreement to be primary can void coverage entirely. verify with your insurer before agreeing to that phrase. And project-specific policies are extremely expensive for a single job, typically only justified on very large projects where the owner is willing to pay for the policy as a project cost. For most projects, offer the firm's standard practice coverage and decline the project-specific ask. Additional insured status is a frequent point of confusion. Here is what it actually means by policy type. Additional insured status means that a third party, usually the owner, is named on your policy and protected by your coverage for claims arising out of your work. The mechanics differ by policy type. On commercial general liability, additional insured status is common and standard. It is normal to add the client to your CGL policy for the duration of a project, and most owner agreements properly ask for this. On professional liability, additional insured status is unusual. Most carriers will not write it, and most brokers will advise against it, because PLI is designed to defend you against claims from third parties, including the owner. Naming the owner as an insured can create a conflict of interest in defending a claim. On auto liability, additional insured status is common when the owner's vehicles are being used in connection with the project, or when your firm carries hired and non-owned auto coverage. And workers' compensation does not have an additional insured concept at all, because that coverage exists for the protection of your employees, not for third parties. When a contract asks for additional insured status without specifying which policy, clarify the question before you accept the obligation. Pull it together. Insurance verification is a pre-signing step, not a post-claim discovery. 5 takeaways from this section. First, a contract requirement that your actual insurance policy cannot satisfy is, in practical terms, a contract you cannot perform. And discovering that mismatch after a claim has already been filed is the worst possible time to find out. Second, 4 standard coverages anchor most architect insurance programs: professional liability, commercial general liability, workers' compensation, and auto liability, each with its own typical limits and its own scope of coverage. Third, contracts that demand disproportionate limits, project-specific policies, primary and non-contributory status, or other unusual terms are negotiable, and the negotiation starts with your broker, not with the owner. Fourth, additional insured status is standard practice on commercial general liability, common on auto, almost never written on professional liability, and not applicable at all to workers' compensation. So when a contract asks for additional insured status, the first question is, which policy? And fifth, every significant contract goes through your broker before you sign, not after, not next quarter, before, because verification is cheap and a coverage denial is expensive. Here is the uncomfortable truth most architects do not want to hear about construction administration. Roughly 30% of all professional liability claims against architects originate during CA, not during schematic design, not during construction documents, but during the phase you are most likely to staff thinly and document casually. The reason is not complicated. Construction administration puts you in the middle of an active job site where every word said, every email sent, and every drawing initialed can become evidence in a later dispute. Use the wrong word. Inspect instead of observe. Approve instead of review. Supervise instead of administer. And you have stepped across a line that AIAA 201 draws very carefully. That line is the difference between a covered claim and a claim that reaches your personal assets. Start with the language. The words you use in the field and in writing matter more here than almost anywhere else in practice. 4 language distinctions, and each one is the difference between observing the work and guaranteeing the work. Site visits and observations is the correct term. Inspections is the dangerous term because inspection language implies you are guaranteeing the work conforms. And a guarantee is exactly what your insurance does not cover. General conformance with design intent is the correct term. Compliance with plans and specs is the dangerous term, because compliance is an absolute standard that no real-world build will fully meet. And the moment you certify compliance, you have warranted perfection. Observed conditions is the correct term in field reports. Approved conditions is the dangerous term, because approval language implies you accept responsibility for what the contractor built. And on shop drawings, you review them for conformance with design intent. You do not approve them. Approval shifts the contractor's liability for means, methods, and dimensional accuracy onto your stamp. These distinctions are not lawyer speak. They are the actual contractual posture AIAA 201 establishes for the architect. And using the wrong word in a routine email can become the document that loses a claim 3 years later. Once the language is right, you need to know exactly what you can and cannot do under AIAA 201. 2 columns set out the authority and the limits of the architect under AIAA 201. On the authority side, you can reject work that does not conform to the contract documents, which is one of the most important tools you have. You can review and certify contractor payment applications, your monthly check on work in place against what is being billed. You can interpret the contract documents when a dispute arises because the architect is the initial decision maker on document questions, and you can determine the date of substantial completion, which carries major contractual consequences for warranty start and final payment. On the limits side, you cannot direct the contractor on means and methods because how they build is their professional judgment and their liability, not yours. You cannot guarantee the building is defect-free. No architect can. You cannot stop the work. Only the owner has that authority under A201, and the architect can only recommend it. And you cannot supervise the contractor's employees because supervision is the contractor's role. And the moment you supervise, you take on liability for worker safety. Stay inside the authority column and out of the limits column. That discipline is the single most important risk management practice in CA. The third pillar of CA risk management is documentation, specifically the 24-hour rule. 6 elements of the 24-hour rule. First, every site visit gets a written confirmation of what you observed, sent within 24 hours, because memory fades, but a contemporaneous record holds up in a dispute. Second, any non-conforming work gets flagged in writing, never verbally only, because a verbal flag that did not become a paper trail might as well not have happened. Third, your site visit log carries the date, weather, attendance, and the stage of work. Context a later claim review will scrutinize. Fourth, photographs of observed conditions are part of the record, especially anything atypical, pre-existing, or potentially defective. Fifth, verbal direction to the contractor in the field gets a written confirmation note before the day is out, because verbal directions are how contractors later argue the architect changed scope without a change order. And sixth, all communication routes through the owner-architect-contractor chain, letting the owner talk scope directly with the contractor, or letting the contractor change details without a written instruction, creates the gaps that become your exposed flank when a claim is filed. The site visit log is your primary defense. Build it every day, not after the dispute starts. Pull it together. CA risk management is language discipline, role discipline, and documentation discipline. 5 takeaways from this section. First, roughly 30% of all professional liability claims against architects originate during construction administration, and the underlying cause is almost always some combination of imprecise language, role confusion, and weak documentation. 3 things you can control. Second, the language discipline is non-negotiable. Use observe rather than inspect. General conformance rather than compliance. Review rather than approve. And never warrant or certify what you cannot honestly stand behind. Third, AIAA 201 draws clear lines. You can reject non-conforming work, certify payment applications, interpret the contract documents, and determine substantial completion, but you cannot direct means and methods, guarantee a defect-free building, stop the work unilaterally, or supervise the contractor's employees. Fourth, the means and methods boundary protects you from contractor-side liability, but it does not protect you from design safety liability. If the design itself creates an unsafe condition, you remain responsible, regardless of how the contractor builds it. And fifth, the 24-hour documentation rule. Written confirmation of every site visit, every nonconformance, every verbal direction is the single most important defensive practice in CA. Build the record every day. The record is what defends you when the claim comes. Most architects use the words marketing and business development interchangeably, and that confusion costs firms real money. They are two different engines doing two different jobs. Marketing is the long game. Build a reputation in the market so that when a project comes up, your firm is on the list of names that gets considered. Business development is the close. Identify a specific client with a specific opportunity. Build the relationship and convert that opportunity into a signed contract. A firm that does only marketing is famous and broke. A firm that does only BD closes the deals it stumbles into but has no pipeline behind them. You need both, running in parallel, and you need to know which one you are doing on any given Tuesday afternoon. Let me put the two side by side so the distinction stops being abstract. Set the two columns side by side and the distinction becomes clear. Marketing is firm-wide and slow. It builds the brand that gets you onto the short list for projects you have not yet heard about. Business development is project-specific and fast. It works a named opportunity from the first phone call through proposal, interview, and signature. Marketing's audience is the general market, every owner who might one day need a school, a hospital, a tower. BD's audience is the three specific owners you know are about to release a request for proposal in the next 6 months. Marketing's payback is measured in years. You cannot trace which awards entry led to which call. BD's payback is measured in months. You can name the project and the contract and the fee. Confuse the two, and you misallocate your best people. The firms that do run thin pipelines and eventually fail when a slow quarter forces layoffs. Now let me show you what each engine actually looks like in practice, the concrete activities that fill the calendar. 5 rows, 2 engines, and you can map almost every business-related calendar entry in your firm to one of them. The website, the journal articles, the social posts, that is marketing, building the reputation that works while you sleep. Awards and speaking engagements are marketing too. Third-party validation that says someone other than you thinks your work matters. The BD side is different. Networking and client entertainment are about specific prospects you have already identified by name. Proposal writing is about converting a named opportunity into a contract, and it lives or dies on whether you have done the upstream relationship work. Interviews and follow-up close the loop, and the follow-up after a loss is often what wins you the next opportunity from the same client, because the firm that disappears after losing is the firm that does not get called the next time. There is a specific trap firms fall into when they forget that the two engines have different unit economics. Pinnacle Architects had a 40% win rate, which is roughly double the industry average, and would, on any conference panel, sound like a firm worth studying. But they were headed for bankruptcy, and the math shows why. Each pursuit cost them about $35,000 in staff time, travel, printing, and sub-consultant input. With a 40% win rate, that means they ran 2.5 pursuits for every win, putting the true BD cost per win at $87,500. The average fee on a win was $180,000, with a 12% profit margin, about $21,600 of profit per project. Every win, therefore, lost the firm $65,900 once you accounted for the chase, and they were quietly going broke while winning more than anyone else. The fix is not to win more. It is to pursue less, more selectively, with higher probability per pursuit. A 25% win rate on the right projects beats a 40% win rate on the wrong ones every time. Let me close with the 5 takeaways you should walk away with on this distinction. 5 takeaways from this section. First, marketing and business development are two different engines. Marketing builds the reputation that gets you considered, and BD closes the specific contract in front of you. Second, the audiences differ. Marketing speaks to the general market, while BD speaks to named prospects with named opportunities. Third, the activities, the metrics, and even the people who do this work do not interchange cleanly. Treating them as the same function is how firms misallocate their best people. Fourth, a high win rate is not, on its own, evidence that your BD engine is working. If your pursuit cost per win exceeds your profit per win, you are bankrupting yourself one signed contract at a time. And fifth, the fix is almost always selectivity, not hustle. Chase fewer projects, the right ones, with higher probability per pursuit, and the math turns from bleeding to building. There is one decision in business development that matters more than any other, and most firms get it wrong because it feels unnatural. The decision is whether to pursue an opportunity at all. Saying yes is easy. It feels productive, optimistic, ambitious. Saying no is harder, because it requires admitting that you do not have a real chance, or that even if you win, you will not make money. But the firms that survive are the firms that say no early and often, because pursuit costs are real, they are large, and they come out of the same labor pool you need to deliver the projects you have already won. A disciplined go or no-go process is not pessimism. It is the math that keeps the lights on. Let me walk you through the 6 factors a real go or no-go decision turns on. 6 factors, and each one can kill a pursuit on its own. Fit is whether the project matches what you actually do well, not what you wish you did. Relationship is whether the client already knows you, because cold pursuits against firms with deep relationships almost never land. Competition and win odds go together. Who else is chasing, what advantage you genuinely have, and the honest percentage you can say out loud. If you cannot, the answer is below 20. Profitability is whether you can deliver at the fee the client will pay. Some projects are wins on paper and losses in execution. Resources is whether you have the people to chase and the people to deliver, because pursuing while understaffed steals from the projects already on the boards. And risk is whether you can live with what could go wrong on this specific project, this specific client, this specific scope. Once you score the factors, you need a rule that turns the score into a decision. Here is what scoring looks like in practice. Each factor gets a weight that reflects how much it matters in your firm's specific situation. Relationship at 25% here, because this firm has been burned by cold pursuits before. Each factor gets a score from 1 to 5, based on the honest answer to the question. Multiply weight by score, sum the weighted column, and you have a single number that turns gut feel into something you can argue about with data. The decision rule is straightforward. Below 2.5 is a no-go. Between 2.5 and 3.5 is a review with the principals, and above 3.5 is a go. The score above is 3.20, which lands in the review band. And that is exactly where you want most pursuits to land, because the easy yes is rare and the easy no is rarer still. The whole point of the framework is to surface the middle cases for an explicit conversation instead of defaulting to yes, because nobody wants to be the person who says no. There is one more lens that exposes which pursuits are actually worth your time. Expected value. 3 projects on the table, 3 different sizes, 3 different odds. Project A is a $100,000 repeat client engagement with a 50% win probability, giving an expected value of $50,000. Project B is a $250,000 competitive bid with a known but not deep client. The probability drops to 20% and the expected value lands at the same $50,000. Project C is the big, shiny one, a $500,000 mega project from a cold pursuit with a real 5% chance of winning, which yields an expected value of $25,000. Most firms chase Project C because the headline fee is biggest. The math says Project C is the worst use of your BD budget because the probability discount swamps the fee size. The lesson is that pursuit cost is roughly constant across all three. Only the expected payoff differs. Pursue A and B before you pursue C every single time. Real firms make this mistake all the time, and the consequences are not theoretical. Wilson & Associates pursued a $400 million airport terminal for 14 months, consuming 2,400 hours of senior staff and principal time, the most expensive labor in the firm. They spent $65,000 on travel, $40,000 on materials and presentation production, and $25,000 on sub-consultant input to support the proposal. Total pursuit cost? $610,000. They finished third out of 6 finalists, close enough that the loss felt like bad luck. But it was not bad luck. A real go or no-go analysis at the start would have shown a 15 to 20% win probability. Weak project fit because the firm had no airport experience and no existing relationship with the owner. A clear no-go. The $610,000 was not invested in winning a project. It was spent confirming what a disciplined process would have told them in week 1. That is the cost of skipping the framework. And for many firms, one chase like this triggers personal liability draws on the principals and a near bankruptcy event. Let me close with what to walk away with on this decision. 6 takeaways from the go or no-go discussion that should outlive this section. First, the no is harder than the yes, and the firms that survive build the discipline to say it early and often before pursuit costs spiral. Second, 6 factors drive the decision, and any single weak factor, fit, relationship, competition and win odds, profitability, resources, or risk, can kill a pursuit on its own. Third, weighted scoring turns judgment into math you can defend in a partner meeting. Fourth, the decision bands matter. Scores below the no-go threshold get killed, mid-band scores trigger a partner review, and scores above the clean-go threshold proceed. Fifth, expected value almost always beats headline fee because probability discounts swamp project size on cold pursuits against incumbents you cannot displace. And sixth, the Wilson lesson. A single bad yes can cost a firm $610,000 and leave nothing behind, an amount that takes years of small project work to earn back. Every proposal you submit and every interview you walk into is built around one truth most firms forget. Clients do not hire firms. They hire people on a specific project to solve a specific problem they have not been able to solve on their own. When the proposal opens with your firm history and your 60 years of legacy, you have already told the client this is about you. When the interview opens with a slide deck of your greatest hits, you have already told the client this is about you. The firms that consistently win are the firms that flip that pattern. They lead with the client's problem, prove they understand it, and demonstrate that the specific people in the room will be the ones who solve it. Everything else, the awards, the experience, the polish, is supporting evidence, not the headline. Let me show you what a proposal looks like when it is built around the client instead of around your firm. 6 elements, and every one of them should answer the same question. Why is this firm right for this specific project? The executive summary leads with the client's goals, not with the year your firm was founded, because the client is reading to learn whether you understand them. Relevant experience shows projects that look like theirs, not your portfolio favorites. The museum on your highlight reel is irrelevant to a hospital client. The team section presents the people who will actually do the work, organized by their role on this project, not alphabetically with 5-paragraph bios about everyone in the firm. The approach explains how you will solve their problem in a sequence they can follow. Understanding demonstrates that you listened on the pre-proposal call and did research afterward, and the proof is in specifics about their site, their program, their constraints. And differentiators tell them why you are right, not why your competitors are wrong. The second one is unprofessional, and it loses you the project. The mistakes that lose proposals are predictable, and you can correct them once you see them named. Set the left column and the right column side by side, and the fix becomes obvious in each row. Generic firm history that could be cut and pasted from any competitor's website is replaced with a specific paragraph about why this firm is right for this project. The Everything We Have Ever Done portfolio is replaced with 6 curated examples that resemble the project you are pursuing. 6 relevant projects beats 60 random ones every time. Alphabetical team bios become a team organized by role on this project, so the client can see who runs the project, who designs it, and who handles the site visits. And the "we are the best" assertion becomes evidence, specific experience, specific outcomes on similar projects, specific reasons this client should trust this firm. The pattern across all 4 rows is identical. Shift the frame from your firm to the client's project. Every sentence in the proposal should pass one test. Would the client care? Firms that fail that test lose proposals month after month and risk bankruptcy when the pipeline dries up. If the proposal earns you the interview is where the real selling happens. 5 elements that separate winning interviews from losing ones. First, who is in the room? Bring the people who will actually do the work, not just the business development principals who will disappear after signature. Clients can smell the bait and switch from a mile away. Second, the style. This is a conversation, not a lecture. If your team talks for 45 of the 60 minutes, you have not built rapport. You have given a sales presentation. Third, listening. Answer the question the client actually asked, not the question you wished they had asked. Pivoting away from a hard question is the fastest way to lose trust. Fourth, ask questions yourself. Questions that prove you have thought specifically about their project, their site, their constraints. And fifth, be genuine. The client is choosing the team they will see every week for the next 2 or 3 years, and chemistry is not optional. Polished and impersonal loses to authentic and engaged almost every time. The most painful insight in this section is the gap between why firms think they lost and why clients actually pick someone else. 4 rows that explain why so many firms keep losing the same way. Firms tell themselves the loss was about fee, about politics, about the competitor's inside track, about a slight mismatch in experience. Clients, when they are debriefed honestly after the decision, say something completely different almost every time. They say the losing firm did not understand the project. They say the approach was not clear. They say they did not connect with the people in the room. They say the firm talked about itself instead of about them. Every one of those client answers points to the same root cause. The proposal and the interview were built around the firm, not around the client. Firms that take these debriefs seriously and adjust their next proposal accordingly win more often. Firms that blame fee and politics keep losing the same way for years. The data is sitting there for any firm willing to ask the client the real question after the decision and listen to the answer without flinching. Let me close with the 5 takeaways you should walk away with. 5 takeaways from this section. First, clients hire people, not firms, and the entire proposal and interview process exists to demonstrate that the specific people in the room are the right ones for this specific project. Second, lead with the client's goals. Your firm history is supporting evidence, not the opening paragraph. Third, the team you put in the interview room should be the team that will actually do the work, because clients can detect the bait and switch immediately and it costs you the project. Fourth, the interview is a conversation, not a sales presentation. If your team talked for more than half the time in the room, you almost certainly lost. And fifth, the debrief data is consistent across thousands of projects. Firms blame fee and politics. Clients blame lack of understanding and lack of connection. The firms that adjust to what the client actually said win the next one. The firms that hold on to the fee and politics story keep losing the same way for years. Module 2 is the part of practice management that decides whether your firm survives. Module 1 was about structure, ethics, and risk, the legal scaffolding of how a firm exists. Module 2 is about whether the firm has enough money to keep existing next quarter. 3 skill clusters anchor everything you just learned. The financial cluster. Read the statements, understand the metrics, and know when the firm is in trouble months before it shows up on payroll. The contract cluster. Price the work correctly, choose the delivery method that fits the project, and recognize the contract terms that have bankrupted other firms. And the pipeline cluster. Market the firm, develop business selectively, and convert opportunities through proposals and interviews that actually win. Walk through this module's reference tables once a year. The architects who do not master this material end up working for the ones who did. Start with the financial metrics, the numbers that tell you whether the firm is healthy. 5 numbers that every principal, and every project manager who wants to become a principal, should know cold. Net Multiplier is net revenue divided by direct labor, and the healthy band runs from 2.7 to 3.0 or higher. Below 2.7 and the firm is leaving money on the table or pricing too aggressively. Overhead rate is overhead divided by direct labor, expressed as a percentage. 130 to 180% is the working range for most firms. Break-even multiplier is 1 plus the overhead rate, and the rule is simple. Your actual net multiplier must sit above your break-even multiplier, or every project loses money before it starts. Utilization rate is billable hours divided by total hours, and 60 to 70% is the healthy band. Higher than that and your people are burning out, lower and you are overstaffed. Current ratio is current assets divided by current liabilities, and anything below 1.5 means the firm cannot cover its short-term obligations without scrambling for cash. Next reference, the fee structures and where the risk lands in each. 4 fee structures, and the question on every one of them is the same. Who bears the risk if the scope drifts? Lump sum puts all overrun risk on the architect. It works only when the scope is genuinely well-defined and the client has no appetite for change. Percent of construction shares the risk with the construction cost itself. If the project gets bigger, the fee gets bigger. And it works when construction cost is reasonably predictable. Hourly with no cap puts all the risk on the client. It is the right structure when the scope is genuinely uncertain at signing, like a feasibility study or a programming-only engagement. And hourly with a cap is the compromise. The client gets budget certainty, and the architect takes the overrun risk above the cap. The mistake firms make is defaulting to lump sum, because the client asked for a number, when the scope is too uncertain to support a fixed fee. That is how you end up working the last 20% of a project at a loss. Last reference, the 4 delivery methods and the single sentence that separates them. 4 delivery methods. 4 different ways the owner trades cost certainty against schedule speed against design control. Design bid build is the traditional path. Separate owner contracts with the architect and the contractor. Competitive bid based on completed construction documents. The owner gets the lowest hard price, but the longest schedule. Design build collapses design and construction under one entity, giving the owner a single point of responsibility and faster delivery, but less direct control over design. CMAR at risk brings the construction manager in during design to provide pricing input, then converts to a guaranteed maximum price near the end of design development. Integrated project delivery is the newest model. Shared risk and shared reward across the owner, architect, and builder under a single multi-party agreement, with everyone aligned around project outcomes rather than scope boundaries. The right delivery method is project-specific. There is no universally best choice, only the choice that matches this owner's priorities, this project's complexity, and this market's capacity. Pull all of it together. That is the takeaway of the module. 6 takeaways that capture the entire module. First, more firms fail from financial mismanagement than from design failures, and the licensing exam tests this material heavily because financial failure becomes public harm. Second, 5 financial metrics: net multiplier, overhead rate, break-even multiplier, utilization, and current ratio tell you whether the firm is healthy, and a principal who does not know them cold is flying blind. Third, fee structure is a risk allocation decision before it is a math problem. Pick lump sum when scope is fixed, hourly when scope is uncertain, and a cap when the client needs budget certainty on uncertain work. Fourth, delivery methods trade cost certainty against schedule speed against design control, and the right method is project-specific, no universal best. Fifth, marketing and business development are 2 engines doing 2 different jobs, and a firm needs both running in parallel. And sixth, go or no-go discipline is what keeps your pursuit cost from quietly exceeding your profit per win. Because the firm that chases everything bankrupts itself, one signed contract at a time. Master this material and you have the financial and business core of practice. Skip it and you will work for the architects who did.